Okay, so good morning, everybody. The Forex lecture got 24I, section 24I that will be covered, section 25D, paragraph 43 in the 8th schedule, and then we're going to do some links with debt write-off that hopefully by now you understand quite well, but then we link it with foreign exchange because it can be that the foreign loan was in a foreign currency, or assets were sold to a foreigner and you had the debt outstanding in a foreign currency. So we need to know how to bring those foreign currency differences into account when we do the calculation. So in the end, when we need taxable income and we need to know what tax is, we need a rand amount. So the first starting point is as soon as you have something in a foreign currency, we're going to need to convert it to rands. So the general rule that we have for conversion is in section 25 capital D. So I want you just to look in your legislation at 25D, and I'll show you the subsections that we will cover. Right. So the heading is determination of taxable income in foreign currency. And the first subsection starts with a proviso effectively by saying subject to subsections 2, 3, and 4. So the general rule is in section 25D, and that is that any amount received by, accrued to, or expenditure or loss incurred by a person during any year of assessment in a currency other than the currency of the Republic. So first of all, I need you to see that it goes both ways. So it goes with the amounts that you receive. So if I sold in foreign currency, or it goes with if I buy something in foreign currency. So either way, whether it is expenditure incurred or amounts that you received, it must be translated to the currency of the Republic, applying the spot rate on the date on which that amount was so received or accrued. So I will always give you the spot rates in a question, and I will also give you average rates. So you're going to need to determine which one to use. Okay. So for a company and for a general rule for a natural person that do not elect out, you have to use the spot rate. Okay. All clear? That's an easy rule. Important just to see it goes both ways. The subsection 2 that can override the first one is when I have a permanent establishment in a country or in a country outside the Republic, and then we use average exchange rate. The reason being a permanent establishment is like a normal business. So in the other country, I do transactions on a daily basis. So if I keep having to translate every transaction every day at a specific rate for that day, then I'm going to have a million calculations. So what they say is keep your business profit in that country in the foreign currency, and only right at the end of the year of assessment, we convert it once and we convert it at the average for the year of assessment. Just easy to calculate. Now the most important one, 2 capital A, we don't do. So for me, a very important one is sub 3. And that is where you have a choice whether you want to go spot rate or average. And it says, notwithstanding section 1, so even though the rule in section 1 is spot rate, a natural person or a trust other than a trust which carries on a trade. So I call it a non-trading trust. So it's a trust that just have the passive income and doesn't have trading activities, may elect, and then I put in the bold, in the blue highlighting the word or, because that's very important. Once you decide to make that election, you can't during a year of assessment chop and change to see which one is best for you. So you may elect that all amounts received by or accrued to that person, or expenditure or losses incurred by that person or the trust in any currency other than the currency of the Republic, be translated to the currency of the Republic by applying the average exchange rate for that year of assessment. So a natural person and a non-trading trust can, per year of assessment, decide what they want to use. But if they decide average, they have to do average for all the transactions in a foreign currency in that year of assessment. Because obviously, if you receive money, you want the gross income to be as low as possible. And if you have an expense, you would like it to be as high as possible. But now you have to determine in that year of assessment that you have more income or more expenditure to decide which rate you're going to use. But once you determine for that year of assessment, you stick to that choice, and then in the next year of assessment, you can make a new choice. Is that clear? Okay. So if I then go back to the mind map, I just summarized it. I said, remember, the company will always use spot rate. They don't have a choice. They will stick to the spot rate. A permanent establishment will use these average exchange rates. And then if you refer back to the definition in section 1, what is the average exchange rate, you will see that you have a choice of using either the closing spot rates on a daily interval or on a monthly interval. So for test purposes, I will just give you the average rate for the year of assessment. But just remember, in practice, you can choose to rather use the daily closing rates or the monthly ones, whichever is best for you. And then for the individual and a non-trading trust, you have a choice, but important, it applies to all the amounts in the foreign currency for that year of assessment. Then just in italics underneath that, I wrote some provisions contain their own translation rules which may override section 25D. So unless I have a specific other rule, I always default back on 25 capital D. Now the two main ones that we're going to deal with is section 6 quat, but that only comes in the resident lecture either next week or the week thereafter, that I will get to 6 quat. And then the 8 schedule one we will do today, and that is paragraph 43 of the 8 schedule. Because now when I get to capital gains tax, I need to know what is my proceeds, what is my base cost, and then we have specific rules in paragraph 43. Are you clear where 25D fits in? Okay, it's a general conversion rule, but we may have separate provisions. Then the rest of the first mind map, I'm trying just to put the provisions in context, that you know when to apply which provision. So we are going to focus on foreign exchange differences and foreign exchange translation of the amounts today, but very important that you remember what you've studied before, and that is when I split it between a non-monetary and a monetary leg. If I say non-monetary, it is the underlying item that I am buying or selling. For example, if I take trading stock. So trading stock, if that is my non-monetary item, and I buy trading stock in a foreign currency, I need to get my trading stock to rand amounts. But what do I do normally for trading stock? I claim 11A, then I have closing stock, and then I keep it with opening and closing stock, right? But now I just have a foreign amount. So all I need to do is I need to change that foreign amount to a rand amount. There's no other provision applicable to trading stock, so my default rule is my section 25D. So what's very important is once you convert that 25D amount, so once I say this is my transaction date, this is how much my trading stock cost me today, then I don't mess with that translation again. So my trading stock amount is then fixed. So when I say I've got half of my trading stock left, it will be half of that rand amount. Not what is the exchange difference on year end. So my non-monetary leg, effectively I only convert once, and then I keep using that rand amount for every other calculation that I need further. Does that make sense? This is important because a lot of students, when I say so much of my trading stock, or I say $40,000 worth of trading stock is still on hand at year end, then they want to convert my trading stock, closing stock inclusion again at year end. And you never do that. So you convert it on transaction date, so that is on 25D, and then 11A and all my 22 rules are based then on that specific rand amount. Okay. Gross income, same thing. As soon as I sell it, I've got a transaction date. That's the day that the money accrues to me, and that rand amount will then be my gross income. Whether they pay me or not, that's irrelevant because the payment is the monetary leg, the cash. When will I get the payment for it? So the non-monetary is my gross income, the trading stock at that point that has been disposed of. You okay with trading stock? The next one is, what if it is a capital asset? So a capital asset, if it is an allowance asset, I need to know what is the rand amount in order to claim wear and tear on that capital asset. So again, my conversion will be 25D on the acquisition date, my transaction date. And once I've converted it, I have it fixed for all my capital allowances. So for example, if I have a section 12C, I get like 40% in year 1 on the converted amount on transaction date. The next year, it's 20% on that original converted date. Don't try and recalculate your cost of that asset. Right, so you calculate the cost once, allowances stay on that original cost for the whole period that you write it off. On acquisition date, do I need to calculate base cost at that point in time? When do I need base cost? Only when I dispose of my asset. So once I dispose of my asset, now I need to do a capital gains tax calculation. So now I need to know what is proceeds and what is base cost. And then I put on the mind map here, my whole calculation will depend if I'm in 43.1 or 43.1 capital A of the 8 schedule. And I will get to that in the next mind map. But that is my CGT calculation. Don't confuse that with my Section 25D conversion for capital gain, for capital allowances. Okay, so far? Okay. Any other deductible expenditure or receipts? Just normal rule. 25D, convert it and put it into your calculation. When I get to the bottom part of that mind map, I call it the monetary leg. So now, if I buy trading stock and I pay for it in cash, do you agree that I don't have another leg? Because I've paid for it. So on that day that I have transaction date, I've got my calculation for my trading stock rule and I've paid for it. There's no further difference that can come in. But if I don't pay for it, so now I buy on credit and there is a debt outstanding, now I'm going to go into Section 24I and I'm going to do exchange differences, right? So when we do exchange differences, we're always going to start with transaction date, and then if I have a year end before I pay it, I'm going to have at year end what we call a translation date difference, and then when I finally pay it, we call it realization date. Now it can go from my transaction date and I pay before year end, and then I'm going to have a difference between my transaction date and realization date. But if there's a year end in between, I'm going to have two different exchange differences. Right? So this is if I do anything on credit. So there is a debt outstanding. So on that part, I put there the normal rule. You're going to apply Section 24I provisions on the translation date, that is my year end date, and the realization date, if the taxpayer is a company or trading trust, because that's a general rule for all companies and trading trusts, they have to do that. There are special postponement rules, and we'll get that when we go through the detailed mind map of 24I. The only exception there that I just want to highlight at this point in time is if you are a natural person, you normally do not fall for your outstanding debt in Section 24I. You only go into Section 24I if you start speculating, but now important, you must speculate with Forex. So if I am buying and selling normal trading stock, and I buy that trading stock on credit, I don't need to do 24I on my outstanding debt. But if I buy and sell foreign exchange currency, or I buy and sell foreign debt, because that can happen too, right? I can buy debt from one person because he needs money, so I buy that debt because I know the currency is going to change and I can sell the debt again. So when I start speculating with the debt and the foreign currency and the foreign amounts, then I start doing Section 24I. Okay? Just keep that in the back of your minds. Main calculation is you do it for a company and a trading trust. For the hedging instruments, which is my foreign exchange, a forward exchange contract, and a foreign currency option contract, those hedging instruments, you always do 24I. It doesn't matter if you're a company, a natural person, trading trust, non-trading trust, your hedging instruments are always subject to Section 24I. Okay. That's just your big picture that you know where everything will fit in, and then we'll look at it in detail when we go through the specific sections. Right, so I'm going to start now with the CGT provision in paragraph 43. So I want you to go in your legislation to paragraph 43 in your 8th schedule. Okay, it's on page 313 on the right-hand side. So when I sell something at the end that was a capital asset and I need to get to a capital gain, I'm going to need to calculate proceeds, base cost, and that will either give me a capital gain or a capital loss. Okay. if my proceeds or my base cost is in a foreign currency, I have a problem because I again need my calculation in rand. So if we read paragraph 43, this is what we call the simple method or the easy method, and you don't have any hidden exchange differences within the calculation. It says, where during any year of assessment, a person that is a natural person, and then again you will see with a natural person we normally throw in these non-trading trusts. If that natural person then disposes of an asset for proceeds in a foreign currency, after having incurred expenditure in respect of that asset in the same currency. So if my proceeds and my base cost are both in dollars or in pounds or in euros or in any other foreign currency, but they're in the same currency, the person must determine the capital gain or loss on the disposal in that currency, and that capital gain or loss must be translated to the local currency by applying the average exchange rate for the year of assessment in which the asset was disposed of, or by applying the spot rate on the date of that disposal. So what they're saying is, let's keep it simple, and you first calculate your capital gain or capital loss, and then we just give you one conversion. So you're only going to translate this final answer, and now you can use the spot or the average. You use the spot on the date of disposal or the spot for the average for the year of disposal. Now, do you think you're bound to what you did in section 25D? Originally, the wording in the paragraph 43s, or the subsection of 43, linked it with section 25D. And when they moved it, they removed the 25D in the first explanatory memorandum, it said the underlining provision of 25D is applicable. But it's very confusing if they don't say convert it in terms of your 25D, because at this point it looks like you have a new choice. So remember in 25D I said all your conversions in terms of 25D for a specific year has to be the same. You have to keep using the average for that year or the spot for that year. And now it seems like when you do your CGT calculation, for that specific calculation, you can pick whatever is best for you for that calculation. So that's the way it looks, and that's the way it seems in the CGT guide as well. So you have effectively a new choice for your CGT calculation. What if I have two CGT calculations? Can I use the spot for the one and the average for the other one? It seems like each one you do separately. Because no, they don't say keep using it for the year of assessment or for all your capital gains for that year. So you can chop and change for your specific transaction. Because remember, I could have sold something 1 January versus the other one 15 February, and my disposal rates can be very different. So I may want to use the average for the one and the spot for the other one. Right. So can you see it's an easy method in the sense that you have one conversion calculation. So if you have same currency, you get the gain or the loss in that foreign currency, and you only do one conversion. Yes? Okay, that's a very good question, is where does your allowances come in? I will show you in the next one, the one capital A, if it's not in this one, where the allowances, in my opinion, will be more relevant. If I'm sitting with a natural person, and I'm sitting with an asset that I bought and sold in foreign currency, do you think there will be capital allowances on that asset? When can I claim a capital allowance to begin with? Don't I have to be carrying on a trade, right? And then it has to be used in my trade. So the idea for this sub 1 is it's normally a fixed property sitting overseas that you inherited, that you sold. You're a natural person, so you're not using it in a business in South Africa. Because if it's used in South Africa, the chances are pretty good that one of these, either your proceeds or base costs, will be in rands, because it will be used in business here. So once your selling price and your purchase price was in the same foreign currency, the default is it's probably something that's not used in a business in South Africa. So I can't really come up with a good idea that this will apply with the capital allowances. Right. So that means if I can't come up with the idea, then I can't test it. So you don't have to worry about that one. So I won't mix the paragraph 43.1 with capital allowances. But your question is very, very relevant, because when we get to the second one, you will have capital allowances linked to that. Can I go on to the next one? You're happy with 43.1? So if you dispose of it, you just check for 43.1, because the default, or if 43.1 is not applicable, then you go to 1A. So you just check for 43.1 first. So 1 capital A is now, as I say, everything else. It says where during any year of assessment, a person disposes of an asset other than a disposal contemplated in subparagraph 1. So it means either it is a company or a trading trust, or it can be a natural person if both the proceeds and the base cost are not in the same currency. So you may have bought it in pounds and sold it in dollars, or one of them may be in rands. I bought it in a foreign currency and I'm selling it in rands, right? In any scenario that's not in sub 1, then we go to 1 capital A. For proceeds in a foreign currency, or after having incurred expenditure in respect of the asset in a foreign currency. So at least one of my amounts need to be in a foreign currency. It can be both in a foreign currency if they're different currencies, but one of them can also be in rand. What you do then is you translate the proceeds into the local currency at the average rate for that year, or the spot rate on the date of disposal. And if you need to translate the expenditure, you do the same. It's either average for the year in which you bought it, or the spot rate on the date that you bought it, that you incurred that expenditure. So this is paragraph 43 sub 1. If I'm in 43.1 capital A, and I need to do now proceeds less base cost, and let's say I have again both in dollars, but I'm now a company, for example, then I'm going to need to change that at spot or average, and I'm going to need to change this at spot or average, which means I will sit with a rand amount there and a rand amount there, and then I have my rand amount being my capital gain or my capital loss. Okay. So if one of those figures was already a rand amount, then I already have one of my answers. I just convert the other one. Okay. So the net effect is in subparagraph 1 capital A, you are effectively including an exchange difference in your capital gain. Can you see that? Because if my exchange rate when I'm selling it was, for example, at 14 rand, and at that point it was at 10 rand, then my capital gain includes that exchange difference. Where if it was only converted once, I have my gain or my loss in a foreign currency, which is a real amount, and then I've just converted it once. Okay. Now, can you see again that I do not have a link back to section 25D? And remember, for 25D, a company had to use spot rate. A company didn't have a choice. At this point, you can play around with whatever rate will be working for you. What do you think is going to happen in practice, though? I think a company will stick to the spot rates. And that is specifically because of your question earlier with the capital allowances. Now, a company works with all their financial records, so they have converted it when they bought it at the spot rate. Now they've claimed capital allowances based on that spot rate. So what would be the easiest? They already have the records for their base cost because they've already converted it at spot when they bought it. So I've got my expenditure incurred in rands, and I can reduce it. Remember, base cost must be reduced with what did I claim for my capital allowances. So I effectively have already got my rand amount completed. So I don't see really in practice a lot of companies moving to the average, but obviously if there's a lot of money involved and they have a choice, it may be worth it to change. Okay. What you must remember then is if you choose the average, and it is a little bit different now than your original spot, your capital allowance won't 100% tie up with that amount. So just keep using the principle. It's expenditure incurred that I've converted now, less allowances claimed. But my base cost can just not go into a negative. So you just then stick to what you have claimed before, and you reduce it to a maximum to get to a null. Which conversion would I use to calculate my recoupment? There's no special rule for recoupment, which means it's the normal rule in 25D. So my recoupment conversion will be, again, based on my spot rate. And again, for a company, I think they will, rather than use that same calculation that they did for the recoupment, they will do for the proceeds as well. But just to know that the legislation do not specify 25D, even though I read all those original explanatory memorandums, and in my opinion, it seems like they still wanted the link. They said, well, we just put the underlying rule, almost like, okay, everybody knows it goes back to what was done in 25D. But it doesn't seem like the interpretation is that now. They say, well, it's open. They can use anything. Questions on this first conversion part of paragraph 43? Okay. So then, there's no 3 and 4. So then the next one is sub 5. It's just a principle that is important. And it says, where a person is treated as having derived an amount of proceeds from the disposal of the asset, and the expenditure was in a foreign currency, then the proceeds must be treated as being denominated in the currency of expenditure, and the person getting it, that expenditure incurred by the person acquiring the asset, must be treated as being denominated in that currency. You will see the reference to the sections there, or paragraphs. It's section 9, capital A, 9HA, paragraphs 12, 38, and 40. Just a principle there, if we take, for example, paragraph 38, can you remember what paragraph 38 of the 8th schedule does? For example? It was not an arm's length with a connected party, or what's the other one? Very common one for paragraph 38? Donations. So let's take the easy one if it was donated. So if I bought an asset in a foreign currency and I give it away for free, now you know it will depend whether my proceeds is in the same currency or not. If I'm a natural person, which rule I must do. So what they do is they try and open the door for the simple method, which means that if you have expenditure in a foreign currency and you give it away, it will be deemed that that market value is in that same foreign currency, so that you can go for the simple method. Okay? Obviously, if you're not a natural person, you don't qualify for the simple method, you're going to go on to the next one, capital A, the subparagraph, but they just open that door for you, so they deem it to be in the same foreign currency. And then the person that gets something for free, if the asset was donated, it is then deemed that they get it in that foreign currency. So later on, for their disposal, they will have to then the rules, either proceeds in the same currency or then a different currency on disposal. Paragraph 40 you don't do anymore. That got replaced by that section 9HA, that is on death. When you dispose of the asset, the deemed disposal on death, and then we do the same rule now. It's deemed the same foreign currency. Okay. And paragraph 12, those are your change in intentions, right? So it's also the deemed disposal rule. Any questions on sub 5? Okay. Sub 6, if a person has adopted the market value as the valuation date value, because the valuation date value is a specific date, it's 1 October 2001. So if you valued your asset and it's a foreign asset and you got the valuation in that foreign currency, then you're just going to use the spot rate on the valuation date, which makes sense because it's a specific date. It's not for a year of assessment. You have to use that specific date. Then, subparagraph 6, capital A, I won't test you on this one. I want to just bring it to your attention, but I think it gets very technical, and I think that's maybe getting too specialized at this point for you. But just see the wording there. It says, subparagraph 1A must not apply. Okay, so first of all, they don't exclude the 1. It's the 1A that mustn't apply. In respect of the disposal by a person of an amount of a debt owed to that person denominated in foreign currency. So the example that I've put on your mind map is if you have, for example, a foreign currency bank account. So let me just show you the example that I've put for you on here. I said the proceeds and the base costs of foreign bank accounts, treasury bonds, and loans of a company must then be calculated under 25D, taking your section 24I6 into account, for example, or namely, reversing what has been included or deducted in 24I. The reason I say this gets extremely technical is if they say paragraph 43(1)(a) doesn't apply. Now you know a right to claim money is an asset for CGT. So as soon as I have those treasury bonds or my foreign bank account, that bank account is not seen as currency because you remember normal currency is excluded from being an asset. So now I have a foreign bank account, which means the bank owes me the money. I put the money into the bank account, now I've got an asset. Now they say if I dispose of the asset, now normally when I put dollars in and I get dollars back out of the account, I wouldn't have any capital gain or loss, right? Like for a natural person. But if it is a company, and I normally have to do the rule to convert each one separately, I may have a different answer, even though it was just my money going into that account originally. So now by saying 43(1)(a) is not applicable, what happens? You default back to 25D, and you convert it, but then it's very tricky because a debt is also a monetary side. So now I've got my non-monetary side being an asset and my monetary side being a debt. So now I do 24I differences on that debt. So right at the end they say, okay, now 24I must get preference. So whatever you've done for 24I, you then have to take out of your CGT calculation. Can you see why I decided that gets just that one little step too far? When you go on with your master's degrees and you work with these foreign debt amounts with these companies, then we can test that, but I don't think it's necessary for you. So from my perspective, whenever I give you a foreign asset, I will make sure that that asset falls either into 43(1) or 43(1) capital A. I won't test the number 6 that says you don't do 1A and then you go back to 25D for those amounts. Is that okay? So if you are working in this sphere or it's interesting to you and you want to just for your own personal read up on it, there is a draft interpretation note out and there's a good example 48. So if you want to see how it works, you are welcome to do that. But it's for interest sake, so it's not for test purposes. And then the last one is 43 sub 7, where they have a long discussion, what do we see as local currency? And for our purposes, we just say local currency is rand. If you have a permanent establishment, it's the functional currency for that, in that country where your business is. Okay, but we treat local currency as rand. Are you okay with the CGT calculation? Okay. So now we're going to go to my section 24 capital I. So if you can maybe rather go in your legislation that we see the wording in the Act. Okay. So section 24I starts on page 151, but before we start with all the definitions, I want to show you the application one that we've already dealt with. Okay. Sub 2. So after all the definitions, you get sub 2 at the bottom. And it says the provisions of this section shall apply. So that means the provisions of section 24I shall apply in respect of any company. So companies must do section 24I. And then on the right-hand side, secondly, all your trust that carries on a trade must do section 24I. And then remember I already mentioned these natural persons that's got this funny rule. So a natural person who holds any amount contemplated in paragraph A or B of the definition of exchange item as trading stock I'll go now to the definition of exchange item after I do the second one, and then I'll show you exactly what they mean. And then the last one is a natural person or a trust in respect of any amount contemplated in paragraph C or D of the definition of exchange item. So we're going to go now to the definition of an exchange item, and you will see there are 4 exchange items. So the first one there, we're only going to do it for a natural person if they hold A and B as trading stock. So the unit of currency or the debt that you will see, you only do the first 2 if they hold the exchange item as trading stock. It's not if they buy trading stock on credit and have a debt. It is the actual exchange item that they must speculate with. So the natural person who holds the exchange item A and B as trading stock will have to do section 24I. And then if the natural person or trust have C or D, then everybody will do it for my FECs, my forward exchange contract, and the FCOCs, my foreign currency option contract. Okay. So your non-residents only do it if they have a permanent establishment in the Republic. Okay. Because normally a non-resident, their currency is there, there's nothing to do with South Africa. But once they're having a business here, they will have to apply it for the permanent establishment. Your controlled foreign companies are no longer in the syllabus, so we're not going to deal with those ones. Okay. So if you've done highlighting it, I just want you to turn then back one page that we can see that exchange item definition. Okay. So exchange item of or in relation to a person means an amount in foreign currency which constitutes any unit of currency acquired and not disposed of by that person, or then any amount in foreign currency owing by or to that person in respect of a debt incurred by or payable to that person. Please remember, if you see the word debt, it can be debt owed to you or debt owed by you. So it can be an asset or liability perspective. As long as it's in a foreign currency amount, we're going to do exchange differences. And then number C is my forward exchange contract, and number D, my foreign currency option contract. So for a company, you don't even think twice. You do 24I on all the exchange items. For a natural person, you always do it for the last 2, the forward exchange contract and the FCOC, but you only do it for item A and B if they speculate with foreign currency. Is that clear? You got the difference? Okay. Okay, so let's run through, let's go to number 3. That's the, what do you do with these rules? So sub 2 said, who we're going to apply it to, and then sub 3 says, with all the rules that I'm going to show you now, what do you do with it? It says, in determining the taxable income of a person contemplated in subsection 2, so the ones that we've just covered, they shall be included in or deducted from the income as the case may be. So included in will be, I've got a foreign exchange gain, and deducted, then I've got a foreign exchange loss. Because they talked in, or name it, any exchange difference in respect of an exchange item of or in relation to that person. So we're going to do for each exchange item that is applicable to your scenario, you're going to calculate an exchange difference. And if it is a gain, you tax it. If it's a loss, you deduct it. There is a special rule, subsection 10 capital A, that we will get to, because that rule wants to postpone it only until it's realized. So we'll get to that one. And then the second part is when I deal with foreign currency option contracts. It's not forward exchange contracts, very important. It's only my foreign currency option contracts, where as soon as I go into that contract, I pay a premium, or the person that's the writer thereof receives a premium, then that amount is immediately taxable or deductible depending on the case. So a foreign currency option contract has a separate extra amount payable or receivable upfront, and that is immediately subject to tax. And then we do exchange differences from there. You okay with sub 3? Okay. Okay, now we're going to run through these definitions. Okay. The first one for me is not that important. You can just read through it, acquisition rate. And that is when the buyer and the seller or the two parties agree on a rate. And then whatever rate they agree on, that then becomes the spot rate. So there is an example in silk, and I give you the reference to that. You can just go through it quickly, but that's pretty straightforward. Normally, I give you the spot rate. I don't work for test purposes really with that acquisition rate. Then I want you to see the definition of an affected contract. Now, that's very important. You will see in previous year's questions, I've tested it quite a bit. So make sure you understand the principle of what is an affected contract. In accounting, they use a term called a firm commitment. Firm commitment, that is when you really want to buy the asset, you have an agreement, but you have not entered into that transaction yet. So you don't have a transaction date. So let's go through the wording carefully that you can see. It says, an affected contract means a foreign currency option contract or a forward exchange contract. So it is your hedging instruments. So I've got a foreign exchange contract or a forward exchange contract. Okay. So the hedging instrument has been entered into by the person during a year of assessment. So those contracts serve as a hedge in respect of a debt. But now importantly, the debt has not yet been incurred by the person, or the amount payable in respect of the debt has not yet accrued to the person during such year of assessment. Okay. So you don't have a transaction date yet. The debt is going to be, so it is to be utilized by the person to either acquire an asset or to finance an expense, or it will arise from the sale. So remember when I used the term debt, I said it can be going both ways. Either you owe someone money, so if you're going to use it to buy something, it means you're going to owe someone. But if you're going to use it to sell something, then someone will owe money to you. So the debt will be owed to you. Will arise from the sale of an asset or the supply of any services in the ordinary course of the person's trade in terms of, now this is important, an agreement entered into by the person prior to the end of the year of assessment. So all I have is I have an agreement, but I don't have the final transaction date. Because remember when I have liabilities and debts for normal tax purposes, can you remember the term actually incurred, unconditionally entitled to, all those terminologies? That is when I have the final incurral date, and that will be my transaction date. So at this point, we were maybe sending emails, and I committed, I want to buy this from you. So from my side, I have an agreement, and I know I'm going to buy it. I hedge it so long, but I just don't have that final transaction date yet. Is that clear? So this will only be at year end that you measure it, whether it's an affected contract or not. Okay. I'll show you with examples what the consequence of that will be. Okay, so acquisition rate and disposal rate, the next one that I didn't highlight, that is the rate where you agreed with the other party, and that is then deemed to be your spot rate. Okay. So now the next definition is exchange difference, and it says it means the foreign exchange gain or loss in respect of an exchange item determined by multiplying your exchange item by the difference between. And now this is just in the legislation wording what I've already explained to you here, that we go from transaction to year end to realization. So it says you take the transaction date, and then on the top of the page it says you compare it to when it's realized, unless there's a year end in between. Can you see that? And then secondly, if you come to the next year of assessment, you're going to start with your translation date, and then you're going to go to realization, or if you have another year end, then you just go to the other year end. So very important when you do questions on these foreign exchange differences is you must draw timelines for yourself, Be very careful to indicate for yourself when is the transaction date, when is the year end, when is the realization date. Because if I have a year end between my transaction and my realization date, I will have two differences. But then I can give you another year end there, then it just means you're going to do another difference between those two year ends, and then only from that year end you'll have to the realization date. Okay? So exchange difference is just in wording explained in the legislation, but if you understood what I explained there, then you're fine. So don't worry about the technical wording then. Exchange item we've already done. Foreign currency is the $100,000 or whatever foreign currency you're buying it in. It's not rand. Then I want you to make sure you know the difference between those two terms. The first one is my foreign currency option contract, and the second one is the forward exchange contract. So the first one, it says it's an agreement in terms of which any person acquires or grants the right to buy from or sell to. You can even make that word right stand out. A certain amount of a nominated foreign currency on or before a future date at a specified exchange rate. The word right means I don't have to, but I can if I want to. So I have a right to buy. That's where the word option comes in. It's my choice. So I'm only going to exercise that contract at the end when it comes to the final expiry date if it's going to be in my favor. For example, if I know I'm going to need $100,000 in 2 months' time to settle a debt, I go into this foreign currency option contract and they say I can buy the currency at 13 Rand. Come the end of the 3 months, the actual spot rate is 12 Rand 80. I'll be silly to buy the $100,000 at 13 Rand because I can go to the open market, to the normal bank, and I can get it at 12 Rand 80. Yes? So now the foreign currency option contract will just at expiry have no exchange differences because I'm just not going to exercise it. I'm going to take my 12.80. But if the exchange rate is maybe 13.50 at that date, then I'm going to exercise my right. So I have a right to buy it. I don't have to. Where the next one, once I go into this contract, it's a forward exchange contract. I don't have a choice to get out of it. It's an agreement where that person agrees with the other person to exchange it at a specific rate. So that's why on a FEC, we're going to have gains and losses because it can go either way. With a foreign currency option contract, over the total, we're not going to have other foreign exchange differences because losses because you're not going to exercise it if it goes into a loss. But what happens, remember when I showed you sub 3, it said that your premium up front is immediately subject to tax, which means that's effectively the maximum that you can lose because you've paid that amount and from there on you can only make gains because if it goes against you, you just won't exercise that option. Is that clear to everybody? Okay. Important, your two hedging instruments. Okay, so the intrinsic value I'm going to get to when I do the foreign currency option contract explanation. Local currency, I told you, you just need to know it's Rand. You don't need to go through that in detail. Okay. Market value I will get back to. And the option strike rate is the rate in the option contract. Okay. The definition for realized is a normal concept when somebody pays, it's realized. When my contract expires, it's realized. So you can just read through that one. Okay. Realization date is normally easy to determine in a question. Okay, so when it's disposed of, it's also realized, or when it's paid, it's realized. Okay. Now we get to a very important part, and that is what rate do I use on these different dates? Okay. So we said we've got these 4 different exchange items, and each exchange item has their own set of rules. How do you convert it? On which date do you use which amount? So if I put there, this is my transaction date, and I put my year end, which is my translation date, and that is my realization date. And we're going to do it in the order there that they've given it to us. So if I need to convert debt, It says debt in a foreign currency. On transaction date, we're going to use spot rate. At year end, whenever they use the term translated, that means the year end date. So the date it is translated, it's again my spot rate, and the date that it is realized, it's the spot rate. So the debt one is the easiest conversion. You draw your timelines, you know which dates you are looking at, and then you just read from the table that I've given you. What is the spot rate on this date, spot rate on the other date, and you deduct the two. Do you have a specific method that you need to use? Which rate you must use before the other one? Can I say it's year end minus that date, or that one minus that one? Does it matter? No, it doesn't matter. So for test purposes, first of all, you just find the right rates and you put them in the brackets and you show me you're going to deduct these rates from each other. Then you apply logic. Then you need to think through, am I making a gain or am I making a loss? The reason I say it doesn't matter which one you put which side is because it depends on whether you sold on credit or you bought on credit. Because if the exchange difference goes from 12.50 to 13 Rand and I bought, then I'm in a loss position. But if I sold, I'm smiling because I'm going to get more rands for the dollars when I convert it after the person paid me. So please, there's no method that you have to think it through before you start. Just put the two amounts in brackets because then at least you've got the right figures there. After you get your answer, you need to then think through, is it a gain or is it a loss? And at this level, there's no little half marks. Oh, at least you got this right. I need the final answer to be 100% right. Because if you tax someone on something that is a deduction, for me, it's quite serious. So please make sure you do apply your mind in the end, because even if your rand amount is 100% correct, but you added it instead of deducting it, you're not going to get any marks for that. So be diligent in thinking it through. Okay, this acquisition rate thing that I talked about, if you did agree with a separate rate, that becomes your spot rate. Okay, but for test purposes, I normally just give you the spot rate. That is just in practice to be aware of it. Now the next one. If I have a foreign exchange contract, an FEC, in the FEC, a rate will be given, and that rate is the rate at which you can buy the foreign exchange difference at the expiry of that contract. And that rate is called the forward rate. Okay? So now it says, if I have a forward exchange contract, on transaction date, the forward rate in terms of such forward exchange contract is the rate that I will use. So I'm going to just put there FR for forward rate. So that is my starting point. Because remember, I need an exchange difference, so I need to compare two rates with each other. So I just need to know which rate to start using. So on transaction date, the date that I entered into that contract, I will start with my forward rate. Then it says on translation date, we will apply the market-related forward rate. So I'm going to say MR for market-related forward rate. What is a market-related forward rate? Right, they explain it. It's the rate available for the remaining period of the forward exchange contract, which means if I went into a 3-month forward exchange contract, and a month later I have my year end, I'm going to find out how much will a 2-month FEC cost me. So it's the forward rate for the remaining period of my FEC. Yes? Everybody good? Okay, just let's go to the last one and then I'll get back to the affected contract. So at the bottom it says the date that it is realized, from that date we're going to use the spot rate. So again I want to say, just find your rates in the columns, you know which one to use, deduct them in the brackets, and then you do your calculation, and then you apply your logic. So what is the logic when I do a forward exchange contract? Now my logic will be, I fixed it in terms of the contract, so I have to determine, am I happy that I fixed it? Because remember, forward exchange contract, I can't get out of it. So I fixed the rate. So I fixed the rate at 13 Rand to the dollar, and I bought something, so I need to pay for it. So at year end, my rate may be 12.80. Am I happy I fixed it? No, because I'm going to have to buy it at 13, and I could have bought it at 12.80. So I'm sorry I fixed it, so therefore I have an exchange loss. That's the way I use the logic. Whatever reasoning you use, make sure that you just think it through, because sometimes my debt is the opposite than my FEC. So just make sure you think it through. It's not always, it depends on how the rates fluctuate, but normally if my debt goes to a loss, I'm normally happy that I fixed it, depending how much of a premium I had to pay, but that normally goes in a contra. Okay with that. Now let's do the green part, the affected contract. So the date that it is translated, the normal rule is you use the market-related forward rate. But then it says, or in respect of a forward exchange contract, which is an affected contract, we're going to use the forward rate. So if I say it is an affected FEC, and an affected contract is only determined at year end, so this one will stay the same and that one will stay the same, but if it's an affected contract, I'm going to use the forward rate at year end. What is the effect of that? I will not have an exchange difference. Can you see that? Because if I start transaction date with forward rate, and on the year end it's a forward rate again, it will always come to a nil at the year end. And what is the logic behind it? You don't have your underlying debt yet. You are hedging something that you only have a commitment to, not a transaction date. So SARS does not want you to have exchange differences until you have that underlying item. So with an affected contract, you will have to get to a nil effect on year end. Does that make sense? Kind of? Okay. I'll get to the foreign currency option contract just now. Let's just do on the next page the easy one first, and that is my unit of currency. Unit of currency, very easy, spot rate, spot rate, spot rate. Okay, so let's tackle now this foreign currency option contract, because this is the one that we normally leave out undergraduate, so I don't know how many of you have been exposed to this one, so I'll just take it slow to make sure everybody's following. If I have a foreign currency option contract, the rule is now a little bit different. So where I normally have these rates, a spot rate or a forward rate, it was normally something like 13 Rand or 12 Rand 50 or something to the dollar or to the pound or to the euro. When I work with this currency option contract, they say that my transaction rate, so this is my exchange rate on transaction date, must be nil. Right? That's always, and that's given. So I'm always going to have in that bracket the nil value for my first calculation. Then at year end, my translation date, in the AA provision, it says, in relation to a foreign currency option contract, which is not an affected contract, you must get a rate by dividing the market value of the foreign currency option contract on that date, which is now my year-end date. I must divide it by the foreign currency amount as specified in that option contract. So I'm just going to use dollars. So I'm going to say it will be the market value at that year-end divided by the dollars that's in that contract. Okay? Forget about the affected contract for now. If you go to the bottom one, it says on the date that we have now, the realization date, we're going to do the same thing. We're going to determine the market value on that date, which is now the realization date, and we're going to divide the market value by the foreign currency amount. Everybody with me? So you see where it is in the legislation? It's market value divided by the foreign currency amount. Okay, we'll get to the provisos and all those rules now. So now on the left-hand side of that page, we have a definition for what is market value. Market value, if you use it for accounting purposes, you can use a market-related value that you determine for your accounting methods, or in any other case, we're going to use the intrinsic value. So the method that we use for our purposes is that intrinsic value. So every time I will see that market value, I actually have to go to the market value definition, but then that refers me to the intrinsic value definition. So if you go to page 151 of your legislation books, you find the definition of intrinsic value. Now this is actually where the whole rule lies. Very important one, so if you need to do it in a test, make sure you open it here and you just follow it through, because you can't go wrong if you have this next to you. So your intrinsic value in relation to a foreign currency option contract means the value. Remember, we're trying to determine the market value. Now they say the intrinsic value. Intrinsic is underlying in this contract. Do you have value? Because remember, we said you have a right. Now, if I'm not going to exercise it, there's no value in it. Nobody would want it from me or buy it from me. So it's the value for the holder or the writer thereof, as the case may be, determined by applying the difference between. Now, in order to get that market value, they say you must take the difference between. So I'm going to have a calculation there of a difference between two amounts. It will be the spot rate on whichever one I'm calculating, because remember, these rules set the same. It says market value on the date. So it can be either at year end or at realization date. So I'm going to use the spot rate on either the translation or the realization date, and I'm going to compare it to my option strike rate. And that is the one that I have the right to buy it at. So maybe it was fixed at 13 rand to the dollar, so that 13 is my option strike rate. So I'm going to compare my option strike rate to my spot rate on that year end, or my spot rate on realization date versus my option strike rate. But then it says multiply that, it's a difference between those two of the amount of foreign currency as specified in the foreign currency option contract. So effectively, it is the difference between two amounts or two rates multiplied by my foreign currency amount. Are you with me? So if I multiply it by the foreign currency amount and I am dividing it again by the same foreign currency amount, the foreign currency amounts will effectively cancel each other out, and my rate will be left with what is in those brackets. Yes? Same thing on this side. The foreign currency amounts will cancel each other out, and I will be left with the difference between the spot rate on that date versus the option strike rate. But then very important, and this is what you need to test for, when you're writing a test, always go and decide, would you have exercised it if you could do it on that date, based on the rates on that date? So if you would not have exercised it, meaning you would have sustained a loss if you went ahead and exercised it, then you have a null value. So check for that null value. It can be that at year end I would have exercised it, so I've calculated again, but then when it came to the real date that I should have realized it now, then I don't want to exercise it. So then this value will be null, but I could have had a value at year end. So remember my differences. It's the rate on transaction date compared to the rate at year end compared to the rate at realization date. And the rate is determined based on the market value, and if I would not have exercised it, that market value is null. And null divided by anything is null. So my answer for that one will give me a null rate. Okay. Let's see if you understood that. In your mind maps, I've given you an open example. Now this example is from the silk, so I don't want you to go into your silk. I want us together to try and calculate this one. And then after this example, I'll give you a coffee break. Okay. So also on this mind map at the top, I've just explained what I've done now. But when I get to the affected contract, I'll go forward and show you the affected contract one. So let's just do this example. It says, A Limited enters into a foreign currency option contract. It's not an affected contract on the 15th of November. and they have the right to buy 300,000 foreign currency amounts at a specified exchange rate of 6 Rand 80. So the 6 Rand 80 is my option strike rate, right? That's the rate that I must exercise it at if I decide to. A premium of 10,000 Rand is paid at the inception of the contract. The option is exercised on the 31st of March 2017, and the year of assessment ends on the last day of December. Assume that the spot rates originally was 690 at end of December, and then at realization date it was 704. So the first part, they ask you to calculate these ruling exchange rates. So the ones that I've put there in the brackets or for year end and realization date, to try and get this intrinsic value divided by my foreign currency amount. So if I get that rate and that rate, I can start doing my exchange differences. So once I have my ruling exchange rates, then I want you to see what's going to happen for the year of assessment. So just quickly determine what those rates are. See if you can get that. So which ones am I going to compare to which ones? Do you get 10 cents for the first one? Okay. So if you just follow the technical wording, it says you take the spot rate on the date that you're trying to get this rate. So we're busy firstly with the year end, the translation date. So the spot rate on translation date was 690. The option strike rate is 680. So we have a difference which is 10 cents. Multiplied by my foreign currency amount, divided by my foreign currency amount. So the market value is that top answer, divided by my foreign currency amount. So these amounts will cancel each other out, and I will be left with a 0.1 rate. Remember, that is now my exchange rate to be used on that date. Are you all with me? Okay. Is the market value null? How do I just check for that null? See, would I have exercised it? And my strike rate is 680 that I can buy the currency at, and the current rate is 690. So yes, I will be in a better position to exercise it. So my market value is not null. Are you with me? Okay. And then at realization date, how will it change? It will just now be the spot rate at realization date is now 704. What do I compare it with? 680 again, because it must be compared to the option strike rate. So for my realization date, it will be 24 cents. Happy? So now if I need to calculate what is my inclusions and deductions for my year of assessment. Do you agree that my 10,000 premium, sorry, my pen. My 10,000 premium is immediately deductible? Yes? That's my section 24I, 3A or 3B said, if you have a premium, you deduct it in full if you paid it, and if you received it, you tax it in full. And then what is my exchange differences? Now I go back to normal rules. So at this point, you have done all the difficult thinking and the differences between my foreign currency option contracts and all my other rules. Now all I need to do is I need to compare my rate from the null to the rate that I've just calculated. So now I go from a null to the 10 cents multiplied by 300,000 foreign currency amount. Remember, that's how you would do all your foreign currency differences. So I've got my foreign currency amount of 300,000 multiplied, my difference is a 0 to a 0.10 cents, and that gives me a 30,000. Is the 30,000 a gain or a loss? It's a gain, right? Everybody with me? For the next year of assessment, my exchange difference is foreign currency 300,000 multiplied. Remember, always I start with the latest rate that I used and I go to the one that I'm busy calculating at. So I need to have the difference between that 10 cents and the 24 cents, and that will give me 42,000. Everybody okay? Okay. Now just to round off this one is, what if it's an affected contract? Let's look at the affected contract rule in the legislation. Okay. So if we're back on page 152, it gave us the rates. It says you always start with the null rate. When you get to year end, we need to get this market value divided by this foreign currency amount, and that's what we've calculated now. The intrinsic value is my market value divided by the foreign currency amount. And now this double B at the bottom, it says, in relation to a foreign currency option contract, which is an affected contract, you must get a new rate. The rate is dividing the amount included or deducted, which is effectively my premium, by the foreign currency amount. So when I go back to my summary here, if it is an affected FCOC, remember, nothing changed with the first and the last calculations. My affected contract is only relevant for year end. So at year end, instead of doing the market value divided by that foreign currency amount, we're going to take the premium divided by the foreign currency amount. Can you see that? It says the amount included or deducted. So that was that upfront payment, that premium. So I'm going to take that premium divided by the foreign currency amount, and that will give me a new rate. So if we go now to our example, okay. So if I need to do a new rate on translation date, they said I must use the premium, which was 10,000, and I must divide that with my foreign currency amount, which is 300,000, and that's going to give me 0,03 repetitive. Yes? So when I get to my inclusions and deductions for the year, I'm still going to have my 10,000 deduction. Are you with me? For the affected contract. What will be my year-end difference now? My year-end difference, if it's an affected contract, so I'm going to just do it in blue so you know it's the affected contract one. I'm still going to have 300,000 foreign currency, and now I'm going to say 0 minus 0,033 repetitive, and that answer will give me a positive 10,000. So can you see what's happening? The answer will always cancel out your premium that you have deducted or included in the beginning. So at year end, the idea is, can you remember with the FEC, forward rate to forward rate? So the idea is they want no tax consequences, because remember, I haven't incurred my debt yet. I just have that commitment. So I have an affected contract. So at year end, the way they have it to cancel it out, you have to take that premium, divide it by your foreign currency amount, and you know you're going to multiply it again by your foreign currency amount, and your original rate is going to be a 0 to start with. So I'm always going to cancel it out. So that 10,000 will now be added, which will make that cancel each other out, and on the affected contract, I will not have any exchange difference. Yes? What's going to happen when it's realized? Now I'm going to have foreign currency 300,000 multiplied by what? Remember, you start always with your latest rate to continue with my comparison. So I've had already 0,033, that's my year-end rate, and now I'm comparing it to the 0,24. Yes? And what is that answer? 62,000. So if you compare the blue now with the red net answer was a minus 10 plus 30 plus 42, which gave me a plus 62,000. If you look at the blue, it was, sorry, that first 10 is now in the red and the blue, because I have a net answer of 0 in the first year. So if it was an affected contract, I had nothing in year 1, and I had 62 in year 2. So my total picture will be the same for both options. It's just when it's an affected contract, everything is moved to the second year. In the first year, you do not get any tax consequences. So your exchange difference will always cancel out your premium. So your net answer must be 0 if it's an affected contract for 24I purposes. Yes? Okay, I'm going to give you a 20-minute break to give you enough time to get a cup of coffee, and then we'll start again. Okay, right, we're just going to finish the definitions quickly before we continue with the rest of the Section 24I provisions. For the ruling exchange rate for foreign currency option contract that we just finalized, if you go to the next page, I said we'll get to the proviso. So on page 153 at the top, the last little bit of the proviso is just on realization date. If you don't exercise your right in terms of that option contract, you can actually dispose of these contracts. A lot of times you get marketable contracts. So then if you dispose of it, then at that point it will be seen as you have realized it. So whatever you have gotten for that, that obviously was the market value, because that was a willing buyer, willing seller price. So there is a proviso that if you dispose of it, then you will just calculate your rate a little bit differently. Okay. Normally, you will use the market value as work with the intrinsic value. Right, unit of currency we've done. Then right at the bottom of the ruling exchange rate, they do have a little bit of a discussion on an alternative rate that SARS will accept if you use it for accounting purposes for your IFRS. So if you have an accounting standard, an accounting rule that you use, SARS is 100% fine with doing that as well. I will get to that one. The debt write-off rule, there is one that they say, well, once you've written it off for accounting purposes, technically you said it was a bad debt, but you're not giving up your rights. If that person come to light and pay you, obviously you're going to take the money. So they say if it's kind of hanging in limbo, maybe one day you'll get something, but for all purposes now you've decided you're not going to get anything. So you've written it off. So at that point forward, you're not going to do foreign exchange differences. Because for IFRS, you have written it off, so you kind of leave it out of your books from then on. But should someone come to light and pay you something later on, then you're going to have an exchange difference from your original date that you wrote it off until the current one. So that's where that IFRS or IFRS comes in. Transaction date. I just wanted you to see the terminology that we've used before when we did expenditure actually incurred or the gross income rule. It used the same terminology, actually incurred. So all those court cases that we've dealt with when is something actually incurred, that is the same principle that we can apply here. And then when is something accrued to me, when I'm entitled to that. So the same terminology for gross income and 11A principles will apply here. All your contracts is when it was entered into. From that date you have transaction date, and then that will be your first rate that you're going to use when you start doing your exchange differences. Okay. And then translate. I've already told you that translation date is your year of assessment, but that's just a confirmation for the definition. So that is the end of the year of your assessment. Okay, sub 2 we've done, sub 3 we've done. Sub 4 I'm going to do right at the end. For those of you that studied previously, just please take note that this is a new section. Section 24I4 was only inserted last year with effect from 1 January this year and applicable in respect of years of assessment ending on or after 1 January 2017. So this is a new provision, but we will get back to that one at the end, the last mind map links with that. Okay. The next provision in 24I is sub 6. It says any inclusion in or deduction from income in terms of this section shall be in lieu of, that means in place of, any deduction or inclusion which may be otherwise allowed under another provision of the Act. So that means 24I gets preference. And the example that I've shown you on the mind map, I said, if your Forex amount equals your trading stock, because remember we discussed earlier that you can actually speculate with these foreign currency amounts or foreign currency debts. So if your Forex is also now your trading stock, when it's realized, what's going to happen? I'm disposing of trading stock, but I'm also realizing a foreign exchange item. So I'm effectively going to have a gross income inclusion and a 24I exchange difference. So then what is very important is to remember that your 24I rule takes preference, and then whatever you've done for the 24I, you're going to have to take out of your gross income amount to make sure you don't get taxed on the same amount twice. So it's just to say which section gets preference, but this is in rare circumstances. It is when you are trading with the Forex or with the debt, but just remember that your Forex rule in this scenario gets preference. That is your 24I6. Now 24I7, hopefully all of you would have come across that before, is when you have the underlying asset just not brought into use yet. Remember, don't confuse this one with an affected contract and those rules. Affected contract means I didn't even have a transaction date, an underlying date yet. What happens here is I actually have bought an asset, I have transaction date, but the asset is maybe still on a ship coming over. I just haven't brought it into use yet. So when that happens, you do your exchange difference as normal, but then you just postpone whatever your answer was to the year in which it is the asset is brought into use. So you calculate it as normal, and then you carry it forward. I put there in italics, or until one of the provisos apply, meaning maybe the ship sank, you're never going to get your asset, or it was destroyed on the way. So when you know you're never going to take it into use, you are allowed to get the exchange differences up to that point. So look at the exclusions right at the end. Silk example 22.8, I just made a little assumption that you must just work with when you do that example. Then a very important example, and that is example 22.9. That is a link with section 24J. There is a small errata in the recon at the end that you must fix. But this example, I need you to be 100% fresh when you try it. And I don't want to go through it now because it's going to take away from a learning opportunity to see that you can actually do that. I will start next Saturday morning with this example in case there's a problem with it. But, sorry, the principle there is whenever we have debt, sorry. We said for the debt, we take spot rate on transaction date, and at year end, we have spot rate again, and we take those two as an exchange difference. What happens with interest? Interest is incurred or accrues on a daily basis. So it means if 3 months before my year end, I have a loan transaction, a debt outstanding, it means I effectively will have 90 transaction dates for the interest that accrues on a daily basis. If it's in a foreign currency, I'm going to have to then take transaction date to year end, transaction date to year end. Can you see the issue? So what's going to happen is we're going to make it easier and say, okay, let's take the average for the accrual or incurral as your transaction date. Does that make sense? Because all the days that it accrues, I can take the average for that. But that average will then be effectively the average of all these spots. So if I'm working with 24J, I will have my transaction date being the average that is accruing up to year end. And then I'm going to compare that average at year end to what? To my spot on year end date. Then don't try and get an average for the year end translation, because I'm not changing my rule. I am doing spot to spot, but I'm just doing a lot of spots in one calculation. Does that make sense? It's hard to explain this one. Okay. So my transaction date will be an average because it's effectively 90 different transaction dates if I took it out 90 days before my year end. So then I have a conversion from that average to the spot rate. But now what happens after year end? I have more interest accruing, which means I'm going to have a new transaction date, which will be my average at that point. That's going to be taken to my realization difference. But what else do I have? And that's the one that the students normally miss in that calculation. You're going to have your year-end calculation from the ones that accrued up to that year-end. And you're going to have to take that answer back to the spot rate. So I want you just to take note of the principle, and then I really want you to try it yourself before looking at that solution. And then once you are happy with your calculation, then compare it to the solution, and then try and fix where you went wrong. And then if you don't understand, we'll start with that next Saturday. Right. Because what makes this one even more complicated is some of the assets haven't been brought into use yet. So now we have two difficult rules in one example. It's a really tricky example. You have the underlying asset not brought into use, so it means all your 24Is must be postponed. So it's the 24I on the actual debt, the loan debt, and the one on the interest debt. Because remember, if interest accrues, that's just a new debt. I have my capital outstanding, but now there's also interest outstanding. So you effectively have two debts that you need to take out in the account. Right. So please try that before you come next Saturday, that we can take it from there if you don't understand it. And then example 22.11 is also a good example explaining 24I7. So if we go now back into your legislation, if you look at sub 7, I'm not going to highlight too much there, but I want you to see, you look at all your exchange differences. So it's the exchange difference from your debt. In sub B, it's also the exchange difference from your forward exchange contract or your foreign currency option contract. Okay. and it's also your premium. So anything relating to 24I, whatever you've calculated, you're going to have to carry forward. So if it's incurred or it arose prior to the assets being brought into use, you can see I've highlighted very little there. I want you to read in between it, but the principle is you're working with machinery, plant, implement, utensils, building, whatever asset you're buying, you haven't brought it into use yet. So the exchange difference prior to you bringing those assets into use will just be carried forward until it's brought into use. Happy with that? You know the rule? Okay. The provisos that I spoke about earlier is just at the bottom. It's no longer going to be incurred. The asset cannot be brought into use. So there's something else that intervened now, and then you can get it at that point in time. Okay. That is sub 7. Sub 8 on the right-hand side. This is something that I think is easy to pick up in a test. If I ever use the words that you did something solely or mainly to enjoy a reduction in tax, you know SARS won't like that. Okay? You have to have a business purpose effectively to do something. If you do it just for tax, then they're going to prohibit it. So in this case, if you then do get a loss, but your main purpose was to claim the deduction, he's not going to give you the loss. But obviously, if you have a gain, he's just going to keep taxing the gain. So if your plan backfired, it's too bad. Right. Now the last tricky rule for 24I is this 10 capital A, before we then do debt reduction as a separate mind map. 10 capital A says, subject to paragraph B, so there's provisos coming up, no exchange difference arising during any year of assessment in respect of an exchange item contemplated in B. Can you remember what was the exchange item B? Just the debt, right? So we had unit of currency, the second one was debt. So if I'm sitting with a debt, then the exchange difference must be ignored. So nothing must be included or deducted from the income. If at the end of the year of assessment, so this calculation deals only with my translation differences. So I'm going to get to the end of the year of assessment, so it means it hasn't realized yet. There is a year end before the realization date. And then we have a list of requirements. The first 3 is for me the most important one. The fourth one, it's rarer, so you can just take note of it. The first 3 are the ones that I want to test. It says, at the end of the year of assessment, you're going to measure whether that person and the other party to the contractual provisions of the exchange item are either part of the same group of companies or they are connected persons in relation to each other. So your starting process is, you see, you have a loan transaction with another connected party or group of company. So that's your first trigger. If any of these transactions are between people that are not connected persons, then you're not even going to go to 10A to consider it. But as soon as you see connected parties and you have 24I involved, that's your first trigger. Go to 10 capital A and measure for the rest. The second one is, you may not hedge that transaction. So there cannot be a forward exchange contract or a foreign currency option contract. So as soon as the transaction is hedged, 10 capital A is not applicable. And then the third important requirement is the exchange item or any portion thereof does not represent for that person a current asset or a current liability for purposes of financial reporting pursuant to IFRS. They are aiming to give specific rollover effectively provisions if you have a long-term loan between connected parties that are not hedged. So in practice, you find it a lot that your holding company lend money to their subsidiary company. So now you have this $1 million loan outstanding. So let's say they granted them a 10-year loan. What happens at year end? Normally, you're going to have exchange differences. And on a big few $1 million loan, it can be substantial. And the big thing about 24I, it's on realized and unrealized exchange differences. So now at year end, the poor companies haven't done anything, but suddenly there's these huge amounts that get taxed. It can go in their favor, that it can be a deduction as well, but I mean, you're working with real amounts that they have no control over. So this is a very nice provision. it came in various forms. So some of you that worked with Forex for a while back, you may remember the rule with a 10%. So every year you would calculate it and only include 10%. That was a nightmare calculation because next year it's 10% of that remaining balance and 10% of this current year, and it was just a lot of calculations to keep track of. So now what they've done is they say we don't do anything. So we wait for you to either fall out of those provisions or until it is realized. Now you also know for IFRS what happens is if I have a loan that is repayable every year, they pay a little bit back. You have to move from your long-term side, you have to move to your current liabilities, the portion that will be realized in the next 12 months. You're aware of that, right? So if you move a portion to your current liabilities, they say it's okay as long as a portion thereof is still long-term. So only when you move the last little bit to current, you don't fall into this provision anymore. So you don't have to keep applying it for that little bit that you put in your 12-month rule. You can keep doing Section 10 capital A as long as a portion stays under the long-term liabilities. Make sense? Then the fourth one that I'm not that interested in testing, but that is when you start bringing other people into this transaction. So it says you're not allowed to, it must not be directly or indirectly funded by a debt owed to a person that does not form part of the same group of companies or is not a connected person. So if you bring someone else in and now they kind of help the funding, then it's not going to help. We're out of this rule. So what they want is they want a direct transaction between this group of companies. So people within your group, or you must be connected. So I don't want extra structures involved. Okay. So if this is the case, then the easy answer is at year end, you're just going to do nothing. I don't want you to even calculate anything. So if you get to your year end, so I have my transaction date and then I get to my year end. So let's say that is year end 1. I measure, we're still connected, it's not hedged, it's long term, a portion is long term. So at that point, I just do nothing. Then I get to my next year end, still meet the criteria, do nothing. Now, during maybe the next year, at that point, either I hedged the transaction, because the currency is going bad now and I know payment is maybe getting closer, or we're not connected anymore. I sold all my shares in that company. Remember, shareholding determines if we're connected. So anything happened, maybe it's then, what was the other one? Yeah, it's hedged, we're not connected anymore, or it is going to realized in that year of assessment. Or suddenly the company came into money and they said, I just want to repay the debt. Maybe the interest is too much for me to cover. So if anything happens and I don't comply with these rules anymore, okay, then what's going to happen is I'm going to do a calculation to effectively fix what I've been postponing all these previous years. So in your section 24I 10 capital A, it tells you how to fix it. So it says, if in this year, so this is my year 3, if in this year I don't comply with 10 capital A anymore, then I have to start from the end of the previous year of assessment, the last day of the year of assessment, immediately preceding this year that I do not comply with 10 capital A anymore, and I have to take that rate and the ruling exchange rate on transaction date. So I take from that year end back, and in this year of assessment, I'm going to then just do as normal. So then I'm going to take it from that previous year end. So that is effectively my year end. That is my year end date. So I'm going to take that year end back to my transaction date. And then I'm going to take from year end to realization date or another year end, which is a normal translation difference, without applying 10 capital A. So without applying and saying, I don't do anything. So in the rule it says, you take it the last year of assessment immediately preceding, going back to transaction date. Then you will see afterwards it says, less any amount that you previously included or deducted. I won't test that part. That is all the old rules that you don't need to know. But remember I told you about this 10% rule. So if ever you had to do something different under the previous provisions, we're just going to have to take that out, because otherwise we're going to tax you or give you the effect twice. So we want to fix from this year end everything back, And now we start with that year end, and the new rule or the current rule is not in 10 capital A because it's a normal rule. So all that 10 capital A tells you is when to not do anything, and when you don't comply, how to fix what that one has been postponing all along. And after that, you do normal rule from year end to realization or year end to another year end. Okay. So what I've done on the mind map, try to just summarize it for you. Okay, so 24I8 was solely for tax benefit. So I said, you don't do anything, no inclusion, no deduction until realization date if the parties form part of the same group of companies or they're connected person and it's not a current liability or asset and it's not funded by a third party and you don't have a hedging one. Okay? So in other words, the group or connected person deferral does not apply if it's a short-term loan, if it's a hedged loan, or if it's funded by a third party. So you calculate your exchange difference when it's actually realized or when the requirements are no longer met. The special calculation is the difference between the exchange rate on the last year end and the exchange rate on transaction date, less amounts previously taken into account, which we won't test you on. And then I say, do not forget to also calculate the exchange difference as normal on the realization date. That is translation, then looking forward for the current year until then the realization date or the new year end. There is an example, so once you understand the theory, then you try that example. Okay. The last one for 24I12 is just if the provisions for 24I becomes applicable or cease to be applicable, and that's normally for a person trading in Forex. If he stops trading or starts trading, it's just how to move him in and out of the rules. Not important for your purposes. Okay. Any questions on 24I? Okay. The basic rules. Now we get to the one with the new 24I4, but I want to do this one in connection or in conjunction with your bad debts. So the heading there, I said we've got bad debt, doubtful debt, subsequent recoupments, and also debt write-off. So it's a lot of issues that I want to just bring together again because you studied now the debt write-off, and the debt write-off is a difficult topic, and it's difficult enough as is. Now to bring Forex into it, it's just adding a little cherry on top that I don't think everybody likes cherries at this point. It is a bit tricky. So I need you to just try and understand the thinking process and very importantly, know who we're working with. If we're working with a lender or we're working with a borrower and in which circumstances. Okay. So if I give you those section references, 11A, 11I and 11J. If we're working with bad debts or people that cannot repay debt, who will get the 11A and when will they get 11A? The lender, right? First of all, it must be the lender because that's a person that loses the money if there's a debt write-off or a bad debt. And when can one get an 11A? If you're a money lender. That's the only time. The only time with bad debt that you can go into 11A is when you're a money lender and you're the lender and that person can't pay you, then that loss is an 11A loss. Everybody good with that? It's nice to have something to say, it's always like that, because with tax, it's like, okay, 95% of the time is that, and then you have to kind of remember this other 5%. So 11A with bad debt is only if you're a money lender and only from the lender's perspective. Okay. 11I, again, only from the lender's perspective. Yes? Requirements for 11I. Yes? Very important. It had to be included in your gross income. So when will that be included in your gross income? What should the transaction have looked like? Say again? Yeah, but when would you include something in gross income? What was the transaction in order to get something in your gross income? You had to sell something? It had to be disposal of trading stock. Because that's the only time I'm going to do gross income. Because if I sell a capital asset, it's not gross income to me. If I just give you a normal loan, it's not gross income to me. So to try and pick it up in a question, so I'm trying to help you to, when you read a question, you need to look for triggers. Because I know you all study hard, and I know you all have the theory. The main difficulty, and that just comes with practice, is to try and bring the theory with the information that I give you. So when you read a sentence, oh, they sold trading stock on credit, and then you see something about bad debt, you immediately had to see, well, oh, it was gross income because it was a sale of trading stock, so the bad debt will go into 11I to begin with. Are you all with me? Okay, so very important, you had the right, in the previous year, it had to be included in the gross income in order for me to get 11I, right? 11J. Exactly. So that's why it's nice to have a rule like it can never be, or must always be like that. So the only way I would have had it in gross income was I had to have a trading stock disposal. You're not going to make the same mistake in the exam. You have to be positive. You're now going to know what to look for. Okay. What is 11J? Doubtful debt. Now, doubtful debt, you know that normally SARS gives you a 25% of your list. So whatever you do for accounting, they normally only give you 25%. But also, if you read 11J, it doesn't say in the legislation 25%. You will never find it there. It says, depending on the commissioner's discretion, right? So for test purposes, I will normally tell you what was doubtful by SARS. The one example from the interpretation note is they took the 25% of the amount, because that's kind of their practice to do that. So doubtful debt, claim in 1 year, what happens in the next year? Always reverse it. So whatever the amount was, you don't even think twice, you add it back, and then if it really goes bad, you do your 11I. Again, it's from the lender's perspective, so it's from the one that had the disposal. Okay? Disposal of trading stock. What is 84A? Recoupments, right? Now, in the context of Forex, can a foreign exchange difference be recouped? Quickly open your legislation to 84A. 84A is on page 44 on the left-hand side. They shall be included in the taxpayer's income all amount allowed to be deducted or set off under the provisions of sections 11 to 20, and then inclusive section 24D, 24F, 24G, 24I, 24J. So if I have a foreign exchange loss that I claimed, I may have a recoupment if I have the write-off of debt. So if I don't have to pay that amount anymore, I've been nice, I had the expense incurred that I'm never going to pay, but while I had the debt outstanding, I was doing these foreign exchange differences. So if I deducted a foreign exchange loss, I'm going to reverse it by 84A, because do you agree that I'm recovering it? I'm recouping, I don't have to pay that debt. What about if it was a capital gain and I don't have to pay the debt back? Can the gain be reversed? No. You got tax on the gain, you stay taxed on the gain. But if you had a Forex loss, 84A may recoup that. Okay. 24I4 is now this new section. So before we go into the rest of the mind map, let's just read for ourselves the wording and then we'll put it into the context. So 24I4 is not a very long provision, but what is very important with that provision is the fact that it starts with the wording subject to section 11. So your 11A and your 11I must be considered first. Now remember when I did 24I6, I said 24I is in lieu of any other deduction. So the normal rule is 24I takes preference. But when it comes to bad debt, you must first do your normal 11A and 11I rule, and then we can do this rule. So it says, subject to section 11, in determining the taxable income of a person contemplated in subsection 2, those are all companies, non-trading trusts, those ones, in respect of a debt owing to that person. Very important to pick up that this provision can only apply to the lender. Yes? It must be a debt owed to that person. as referred to in paragraph B of the definition of exchange item, to the extent that it has become bad. So to the extent that the money is owed to you being the lender and the money cannot be recovered, it has become bad, what you need to do is you need to reverse what has been done. So the amount of the foreign exchange gain relating to the debt, because I just said you in 24I normally, because it must be a person contemplated in subsection 2, you have been doing exchange differences on the debt that's outstanding. And now that debt that was outstanding just went bad. So to that extent, if you had a gain, now the gain will be deducted. If you had a loss, the loss will be included. So what are they doing? They're reversing what has been done before. So the rule is not a difficult rule. It makes sense because you were working on an exchange item that actually, if it's written off, never existed to begin with. Because you thought you're going to get the money and now it's written off, so you're not going to get anything from it. So to the extent that I had a gain before on the money that went bad, I'm going to deduct it. To the extent that I did deduct it before, I'm going to add it back. Are you okay with the principle? Not a difficult one. But the trick comes in to remember and to see that it's subject to section 11. So if it is a money lender, or if it was the sale of trading stock that goes bad afterwards, you will have 11A or 11I applicable in that scenario. And then that will take preference, and you're not going to do the part to the extent that you've already taxed it in terms of 11A or I, or deducted it in terms of 11A or I. If I have, for example, just a capital loan, and I'm not a money lender, if I granted the capital loan and it goes bad, I'm not in 11A, I'm not in 11I, so I have to do 24I4. The link's okay, just which one to apply when. Okay? So the 11 is not always applicable, but if it is applicable, it gets preference. Yes? So let's go back now to the mind map. So on my heading, I put now the 11A, I, and J we're going to look at, recoupments, 24I4, and then also section 19 and paragraph 12A. Who does section 19 and paragraph 12A apply to? The borrower. Always the borrower. So I don't want you to mix rules. So you need to see when can the borrower have forex issues is when the money that was borrowed is in a foreign currency. And then they get the benefit of the money being written off. So then it's going to depend. If they bought trading stock, we're going to look at our normal recoupment rules. And if they bought capital asset, we're going to look at 12A, reduction of the base cost, and then going into 19. Okay. So what I've done is I've summarized the 24I4 that we've just discussed at the top. I said that new rule is applicable only to the lender, and effectively we have the reversal of the foreign gain or loss to the extent that the debt owing to the person has become bad, but it is subject to 11, which means that my foreign exchange gain previously included, which qualified for a deduction under section 11A or I when the debt becomes bad, is not again deductible. Okay. So if you already deducted it under 11I or A, we're not going to do it again. Stated differently, if the requirements of 11A or I and 24I4 are met, in relation to a foreign exchange gain previously included, the section 11A or I takes precedence. Now, unfortunately for you, I always ask reference to legislation. So I'm not interested just to see it's plus 10,000. I want to know which section are you applying. No just gut tax calculations. You need to know the detailed rules. Okay, so when this calculation came out, or this section, I thought, oh yeah, it looks easy in the legislation. I read it, and I thought, let me just see what Silk did. And then the Silk example got me completely confused because I couldn't follow their logic. And then I found the interpretation note that's in draft format at the moment on SARS's website. It's a nice long document, so if you can't sleep, you can take that document. It's a 157-page document on an interpretation note. I thought the debt write-off one was a lot. It was 88 pages. So this one is like double that amount. But in there, I found very good discussion on this whole bad debt and debt write-off, which I think is very valuable. So I've shortened it as much as I could. So it's about 8-page document that I've loaded for you on ClickUp, where they explain it again, and then I have the examples. And then after looking at that, I agreed with the interpretation where I understood what it tried to do, but then I tried now to fix your silk example. So what the silk example did is they tried just with plain rules to do 24I4 and then the 11I deduction, but then unfortunately they had to do the 11I completely, and then there was no 24I4 in that example. So that example doesn't really explain 24I4 because it was trading stock that was sold on credit, which means you do the whole 11I. So what I've done is I fixed it so that you can fix it in your silk book so that you don't study something that is incorrect. But then at the bottom I said, maybe rather refer to example 59, and that's the one that I'm going to do with you in class now, just to make sure that you know all those principles. But all the examples in the interpretation note, I would like for you to work through, please. Very good examples. And just before we get to that example, just the last one is I've also loaded the document from the interpretation note 91 that deals with debt write-off. There are 3 examples in those ones, and that's a discussion on the borrower having debt written off and how they need to do a recoupment or the paragraph 12A provision. Okay. So when you study debt write-off, you study it for normal, for your year test, or your big test coming up in September, and then you make sure you link it to your exchange differences. The assignment is in about 3 weeks, right? Okay. The assignment will just be on the lectures from today till the Saturday before the assignment. So you can expect some debt write-off and things in there as well. Okay. So let's do the first one with 24I4. I want to just do the last example. We'll see if we have more time, we can do more of them. But the last example is example 59. Okay. And it says that we have a company with a year end of February. On the 1st of April, year 1, they sold goods for 100,000 Rand to the foreign company. They were not connected persons, did not form part of the same group of companies, and the debt was payable on the 30th June of year 1. Now the company went into liquidation. Company A wrote off the debt as bad the end of February. So that is my year end, which is my translation date. They wrote it off for accounting and tax purposes because of concerns over its irrecoverability. Company A did not waive its right to recover the debt. I underlined that in red because I just wanted to discuss that for a minute or two. When I write something off, it's just an accounting transaction, and I think I mentioned it before, that you kind of leave it open and hopefully something can still happen and you can get some money from it. So the company goes in liquidation and you think, the chances of me getting anything is nil. But then they liquidate all the assets and they try and determine what money is available, and then it depends who's got preferential claims and concurrent claims, and they in the end decide who can get what. So then what happened is I still had it effectively open, so I didn't waive all my rights. Because if I waive my rights, I have a CGT disposal of that asset. So until I don't waive my rights or it's not finalized, like the company then went into liquidation, the final distribution was made. So in the next year of assessment, we did get some money. We got 50 cents in a dollar. So I wrote everything off, and then I recovered something again, which will give me an 8-4A normal recoupment. Okay. So if you do have it in front of you, try and close the results that you don't look ahead, that you can just try it yourself first. So the first one I can't close because it's on the same page, but let's just start. What is my gross income in the year that I had the transaction? So April year 1, they sold it. So in the year that they sold it, what is my gross income? Which rule will I apply? Section 25D will give me the conversion, right? So on the date that I sold it, the 1 April, I will use the transaction date rate of 1 April, which will be 1130. So 1130 times my 100,000 rand, dollars, will give me an inclusion of 1.13 million. You all happy with that? Basic rules. So whenever I have something in foreign currency, I'm going to go to my 25D, unless, for our purposes at this point, it was a CGT calculation. Right? Now I get to my year end. So at year end, I'm going to do a 24I conversion calculation. Which rates do I use? Year end rate compared to transaction rate. Yes? And busy with the company, busy with debt, so it's all spot rates. So I'm going to take 1140 and I'm going to compare it to the 1130. Doesn't matter which one is first or last in the brackets. And then I multiply it with that $100,000. Okay. Are you all happy that that 10,000 rand is a Forex gain? Because you sold it, so you're going to get the dollars. So if I get dollars at 1130 and then at year end it's 1140, I'm at a gain position. So I'm going to include the 10,000 as a Forex gain. You all good? Yes? And now at that year end, we wrote off the debt. So now I need to calculate, because I'm not a money lender, but I sold trading stock on credit, which means it was included in my gross income, I need to do an 11I calculation. Now tell me, what do you think is the 11I? Just try it. Which section will I use for the conversion? 25D, yes? So what is the amount? I will use 25D rate, which means it will be 1140 on the day that it goes bad. So my 1140 will effectively have already included now my foreign exchange difference. Just think that one through a little bit. The same rate being the 1130. But when is the transaction happening? Shouldn't we read 25D again? Because what happens on that date? On that date, it goes bad. So now it says, for any deduction, so if we go to the 25D wording in the legislation, see, that's why you must be careful to apply the gut feeling. You would have said, well, the 1130 was included, so I want to deduct now 1130 because 1130 went bad. It's not 1130 that went bad, it's $100,000 that went bad. So when I look at my calculation, it says any amount received by accrued to the person or expenditure or loss incurred by the person, it must be translated on the date on which the amount was received or accrued, or the expenditure was incurred. So now I have a loss that is actually only claimable when it goes bad. So on that date, I have an 1140 rate. And that's why they made that 24I4 subject to Section 11. Because your Section 11 may already cover up to that point, which means you would have already taken everything into account for 11I. And then I don't have 24I4 applicable to try and reverse that 10,000, because effectively it was reversed by 11I. Kind of okay? So if you can remember to do your 25D on the date that whatever happens, either the inclusion or the deduction that you want to claim, then it will help you not to try and apply logic. And I think that's what happened in that silk example. When you start looking at the silk example, they tried to reverse that one, and then they wanted to do the 10,000 with the 24I4. But when you go back to 25D, then you will see you already have taken it into account. Okay, up to here. Now it gets even a little bit more tricky, because now we have a recovery because the liquidation happened, but then there was a 50 cents in the dollars that you received now from the liquidators on the 1st of May. So as soon as the debt is now realized, they are paying me $50,000 of the debt is recovered. So $50,000 that was written off, we're never going to touch that again. I did put the technical issue where they say we're going to use the alternative rate like for accounting. So we stayed at 11.40 the year-end rate. I don't even want you to show anything for the portion that is written off and you never get back. So it's only when you've written off something and you get it back that we have a realization difference now. So that was in my year 2, and now I'm in year 3. So what happens in year 3? We have this recovery of the 50 cents. So if I do a section 24I exchange difference on realization date, what would you say is the answer? I want to know if it's a gain or a loss, and I want to know the amount. Minus? Minus, because it's an exchange difference. So exchange difference is always two things that I must compare. So I must deduct it. You're 100% right with starting with the $50,000. But now I multiply it by the difference between two rates. You already said 1150 versus 1140. Are you all with me? It's the year end, 100% right, up to realization. Remember when we had the difference rates, transactions to year end to realization. So we've got another 5,000. Is that a gain or a loss? I sold on credit, so it means if the rate goes higher and higher, I'm going to get more rands, which is good for me because I'm the one not paying. Say again? It's a gain because the rate, if I sold the goods and the rate goes from 1140 to 1150, it's better for me because I'm getting more. If I were to have bought the trading stock, then the answer would have been a loss. Right? So this is from the lender's perspective because he sold it. So for the extra 5,000 from the previous year into realization date, the rate went in his favor, so he has an exchange gain.
I just want to ask you, year 2, we technically wrote it off over 11I.
Yes.
So why can we do a realization date 24I?
Okay. That's why we have that part that's underlined in red. Because I did not give up all my rights. So I wrote it off for accounting and tax purposes because I didn't think I'm going to get anything. So at that point, I complied with the rules that said I tried everything, they're going to liquidation, I wrote it off. But it technically stays open. The debt is not completely waived. So if at any point I get something, that debt is realized. So then I have to take it from the last time that I have converted it, which was my translation date at 1140, until realization date. So I will still have an exchange difference if I get money back from an exchange item. Yes, yes. That's why I said the other one, I have kept it in your thing there. I said no exchange difference on the portion not recouped. But there's a long discussion in example 58 that I kept in that you can just see the reasoning why they say it's kind of with IFRS because you wrote it off and you're not expecting anything. So we're not going to keep making exchange differences on those amounts. But if it happens that you do recover something, at that point I just need you for that portion to do an exchange difference. Is that clear? This is important. So don't do anything for the portion that is not recovered. Okay. But because I haven't really relinquished all my rights for this debt, it was just an accounting entry or a tax deduction. I have claimed it in my books. But obviously, if the client, there's still any chance that I may get something, I keep it open for, it's almost like the one student said to me, you tell these people, but you don't tell those people. So you tell the accountants that you're writing it off, but you don't tell the person that is owing it to you that you've written it off. He hopefully will still be able to pay you. Does that make sense? Okay. So I have a foreign exchange calculation, but only to the extent that I have recovered it. And now what else? Recoupment. How do I calculate that recoupment? That one will be in terms of section. A normal 84A recoupment. What do you think is the amount? But I only recovered half. I only recovered half.
You're half up to 1,1,1.14.
1.14. So I've recovered half of a deduction claimed. Now this is where the logic is very important. When I claimed the original 11I, I had to do a conversion based on what that foreign amount was worth when I wrote it off, right? What is the principle for a recoupment? I am recovering a deduction that I've claimed before, what you lost. Half of the 1140. Now, but that's on realization date. That's on realization date. So I have that exchange difference, and then the balance is what I've recovered from the one that I've written off. Say again, must I test it in an exam? I'm going to play nicely around with all these figures. Not just in the exam, I'm going to give it in your assignment, and I can give you some more in the year test. And in the final exam. Will you get it right? I need you to get it right now, but these things, it's easy when you do this, but when you're under exam pressure, it's not so easy.
I'm glad you realize that.
I do realize that. I've been a student myself, and I can tell you, and this is on camera now, I did not pass everything always the first time. So I promise you I do realize how difficult it is.
I use paragraph 57 as a test. It's not even in your solution.
It's not in my solution. Which one? Paragraph?
57. In one of the questions, I use paragraph 57. The Asian, the 1.8 million rand. And you don't even have that in your solution anyway.
But maybe it wasn't applicable. You can come and show me which one you want to do. Can't remember all the questions. I said so many questions. I only used the relevant ones. Okay, so this was example 59. I just quickly want to show you, in this extract, in the beginning part, they explain your 11I and 11J versus the 24I4. So in the first example, they have a doubtful debt that came in, and what's nice is when they keep using different exchange rates that you can see how it works. This first one, they used the 25% for the doubtful debt, and I've told you that I will tell you exactly what the doubtful debt allowance is, so that's just something extra that you use for this one. But what is important, I just want to show you, whatever your 11J deduction is, you do the thinking part at that point, which is my exchange difference when it's doubtful. And then when you get to the next year of assessment, you don't think again, you just add back exactly what you've claimed for your 11J. Okay? So that's the main principle from that example, not a difficult example. Then they've explained this 24I4 that came in, and they said, remember, it's subject to 11A or I. So in this example, we have the 10,000 exchange gain again. We've got gross income, so we've included that. And then when you get to your 11I, they show you exactly what we've done here, that you do your 25D on the date that your 11I becomes bad. Then they have right at the bottom, we said like a little explanation. Now for test purposes, you don't need to show me the explanation. But effectively, they try to say, but this adds up. So my foreign exchange difference was part of my 11I deduction. So that's why I don't get a 24I4 again. So it's a nice explanation there. And then with this next one, example 56, now we have a capital loan. And as soon as it's a capital loan and I'm not a money lender, it's not going to be 11I. So now they try to show you, you're still going to have your foreign exchange difference on the year-end dates, but then because you could not get 11I, now you're going to start applying 24I4. So whatever your loss was, you're going to reverse it. Whatever your gain was, you're going to reverse it. So this is a good example of where 24I4 is applicable. And that is when you don't have your normal bad debts for 11I. Okay. And then this next one was, again, a capital loan. But what happened in this one is we repaid 40 and then we wrote off 60. So to the extent that you did repay an amount, you would have an exchange difference. And that one you can never reverse because that was a real calculation. So to the extent that we're going to write off the other 60, so you will see the 4,000 will stay relating to the first 40,000. But then we're going to have an exchange gain of 6,000, and then we're going to have an exchange loss on 12,000. So when that capital loan goes bad, we're going to reverse the 6 and reverse the 12. So our net answer over the 2 years will just keep us remaining with the 4,000. Does that make sense? So if it didn't go bad, it stays intact. If the debt goes bad, we have to reverse the previous gains and losses on the foreign exchange. If it is on a capital account, if it's not on a capital account, it would have been taken into account for 11A and 11I. Say again?
Giving a typical exam. In the exam, you're looking at test on the last 30 minutes of the lecture. That's the first part.
But that's where you make the mistake. I test the first easy ones, the first hour or 2 hours of a lecture. And those are the easy marks that the students miss. And then they get strangled in this difficult stuff. And they don't do the normal ones. They don't do my 11A on the trading stock. And I promise you, I test the easy stuff too. I test enough easy stuff that everybody must be able to get the 50. And then the difficult stuff, it's actually to get between the 75 and the 90% candidates or 100% candidates. I do test all the stuff. So there's my recoupment rules. So you've got example 58 on the recoupment. And yeah, you can go through that one, the same principles. Okay. Can I go on to the interpretation note 91? Okay. I'll call Jade and see if she can come in a little earlier. I told her to be at 12. What I'll do is I'm going to finish interpretation note 91. And then I'm going to put the test out that you can get the test. And I'll see if Jade can be a little bit earlier, maybe like about 11:45. And then she can do the, because it's going quicker than I anticipated. Okay. So I want to just quickly discuss this 3 examples on the interpretation note. Interpretation note 91. Okay. So interpretation note 91 is now from the borrower's perspective mainly, because that's an interpretation note that dealt with section 19 and paragraph 12A. So that's the borrower. So please do not mix the two. And I think that was the biggest problem in the test too. When I had that Fetsang and Marco and the company, students got confused who they are discussing the rules for. So if I have the borrower, which was the company in that case, you have to go through the rules for the borrower. So it's either 19 or paragraph 12A, depending on the rules and on the mix. Okay, so just the theory. The definition of reduction amount in your section 19, your paragraph 12A, do not indicate how the reduction amount is denominated in foreign currency, how it must be determined. So if we don't have a specific rule, you're comfortable now, hopefully, to know that you go back to section 25D. So my conversion will be done in terms of section 25D. But what I want you to see here is the conversion will be, why doesn't it want to give me that? Doesn't want to give me the one that I can actually write on it. Okay, don't worry. It is the date on which the debt is reduced. Okay? Very important, my debt reduction works on a specific date. Remember when I did the CGT calculations, I said to you that works at the end of the year of assessment. So my debt reduction is on the date that it is reduced, and on that date I'm going to convert it to rand at the spot or the average rate. The reduction amount of a debt denominated in a foreign currency may therefore include amounts of foreign exchange gains or losses that were included in or deducted from income. Now, very importantly, my foreign exchange losses that I've claimed in one or more earlier years of assessment upon the annual translation of the outstanding debt to rand or upon the realization cannot be recouped under 19.5 because they are not expenditures contemplated in section 19.2. But you must recover all your 24I deductions under 8.4a. I showed you that 8.4a covers my 24I. So when I have claimed prior to this debt write-off, if I have any foreign exchange losses and I don't have to pay the debt anymore, that is a recoupment, and it is in terms of section 8.4a. But then remember what I said, my foreign exchange gains just remains taxable. I don't do anything with my foreign exchange gains. Then with the first example, company A and B do not form part of the same group of companies. They have the year end, the end of February. On the 1st of April, company A purchased a second-hand machine for $100,000 from company B on credit. The exchange rate was then 10 rands to $1. Company A claimed the capital allowances. You comfortable with that calculation? It's now 20% of 1 million because on the date that I buy the asset, I convert it to the rands, and then my exchange difference, my capital allowance will be on that converted amount. The debt was payable on the 31st of May, but it remained unpaid and was eventually waived by the company B on the 31st of January when the exchange rate was 12 rand because of their inability to pay. The machine was held and not disposed of by company A. What would you do? Where will you start? Okay. So everybody is happy with your 12C deduction. They told you you've claimed 200,000. And now I have a debt write-off. What is my debt write-off? In rand. So which date do I use to get my debt write-off? It will be the $100,000 multiplied by the 12 rand. Okay? So the debt written off is 1.2 million. Yes? Now I just have to do my normal rules. My normal rules, do I start with section 19 sub 6 or paragraph 12a? Always start with 12a, right? Capital asset, I start with 12a. So if I do paragraph 12a, I still have the asset, so I'm in 12a3. So 12a3 says, reduce my base cost, reduce my expenditure incurred. Okay. My expenditure incurred, everybody happy with the million? That was original expenditure incurred. I've already claimed 200,000, which gives me 800,000. Yes? Can I do paragraph 12A3? Yes. My 12A3 amount will mean I will reduce it to nil. Yes. And then 19.6. 200,000, right? I can only recoup to the extent that I've claimed the deduction. But now I have a problem because I have a debt write-off of 1.2 million. I've only done now 800 and 200. What happens with the other 200? Say again? It's an 84A recoupment. So it says, under Section 84A, the excess reduction amount of 200,000, because I had a 1.2 debt reduction, I've already used 800 against my paragraph 12A3. I've already done 200,000 against 19.6, so now I have another 200 left. In this regard, the waiver of the debt triggers a recoupment under 84A, since the foreign exchange loss of 200,000 was allowed as a deduction under 24I3. Did I not show you the exchange difference? Sorry, I forgot to show the exchange difference on this one. That was my debt written off. I had to show you the exchange difference as well. The exchange difference there was on realization date. I had 12 Rand minus 10 Rand of my debt outstanding. Because remember, at the first year end, I had a debt outstanding still of 1 million. So I have a exchange difference of 200,000. And now I have a debt write-off. So the exchange loss is recovered in terms of 84A. So there's my 84A recoupment of that 200,000. Following? So I do my normal rules. I did my paragraph 12A3. I did my 19. But because my debt write-off amount must be converted to Rand on the date that it's written off, if everything is not covered, it will probably be then a 24I recovery. So what happens if I change this one? In the next example, you will see it will be the same principles, but now instead of having a 12 Rand when the debt is written off, if my exchange difference on the day that it's written off is not 12, but it's 8 Rand, how will it differ now? So, say again? Unfortunately not. We need to keep you challenged, otherwise you're going to get bored and you don't want to do the course. I like to add some challenges. Okay, if I give you an exchange difference of 8 Rand at the realization date. So instead of having it 12 to 1, at the year end it's 8 to 1, or realization date when it's written off, it's 8 to 1. Do I have now a gain or a loss? I'm going to have from 10, I go to 8 times my $100,000. Do you agree that that is a gain now? Right? Because the debt that is outstanding, it was at 10, now it goes down to 8. So the debt is, from the person paying it, it's a gain, foreign exchange gain. And now I have my debt write-off, where the other one was a 200,000 loss, so this one is a gain. So that is a forex gain. And now I have my debt write-off. So my debt that is written off is now 100,000 times 8, because remember the rule is you must use the exchange rate difference or exchange rate on the day that the debt is written off. So I have 800,000 written off. Are you following? Sorry. Is everybody okay? You must please stop me if it's not clear. So the rules, the example stayed exactly the same. So all that changed was the write-off amount. So if I have, it remained unpaid and was eventually waived on the 31st of January, and at that point, you give you the rate. So at this point, it's 8, so it's 800,000. So now I need to do my 12A3. First, remember, what was my base cost at that point? 800, because I had $1 million to start with, and then I had 12C of 200,000, and now I can do the full 800,000 in terms of paragraph 12A3. Can I do now section 19.6? No, because remember I can only go to 19.6 if I couldn't do everything under paragraph 12A3. So I don't have anything else to recoup until under 19.6, And now my full write-off amount of 800 has been taken into account. So it means I stay taxable on the foreign exchange amount, and I've reduced my base cost to nil. So if I were to sell this asset later on, I will have a nil base cost. Yes? Then the last one. Okay. Example 39. Debt denominated in a foreign currency, and now not an allowance asset, but I have trading stock. So if I have trading stock, you know I'm going to have 11A deduction, and I'm going to have my closing stock at the same original converted amount. Remember, my closing stock figures don't change as my exchange difference change, but I have a debt that is then subject to section 24I. So they say company's A year of assessment ends on the last day of February. On 1 April 2015, company A purchased trading stock of 500,000. They bought it on credit when the exchange rate was 12 Rand and 10 cents. So to begin with, you know you're going to have your 11A deduction at that point of 500,000 times 12 Rand and 10 cents. And that will give me my first deduction. That's when I get my deduction. Okay. And that is 6050. The debt was payable the 31st of May 2015, but remained unpaid and was eventually waived by Company B on the end of March because of Company A's inability to pay. Can you see the difference also here when we say the debt is waived? That means that debt is gone from the lender's perspective as well. He doesn't keep it open to maybe get more money. So there's a difference between the waiving of a debt and just writing it off as bad. Can you see that? So if I waive it, I tell the person, you never need to pay it back for me. So that's a final transaction. So it's then waived because of Company A inability to pay. The trading stock was held and not disposed of by Company A the end of March 2016, and then they give you the exchange rate on that date. And then it was sold only in April when it was 15.6. Okay. So do you agree with that first part, the income tax treatment of the trading stock? Is I've got my 11A deduction, and then I'm going to have my closing stock inclusion at 6050. Yes? Same when I get to my next year, I'm going to have opening stock of 6050. Yes? What is my 24I? Where does 24I come in? At year end, so that was my closing stock. So in the same year of assessment, I'm also going to have a 24I exchange difference on the debt, because the debt is my exchange item. It's a company, so at year end I need to do a difference between my year end rate, which is the 1510, and the 1210 times my 500,000. And that answer is there, the 1750, and it's a loss. Follow the logic? I bought something, but I bought it on credit. So I have a monetary leg and I have the non-monetary leg. So my trading stock, it's 11A closing stock as well. And then the other side is the debt that is outstanding, and that is my 24I, and it's year end back to transaction date. Yes? Everybody good? Okay. Now when it is written off, so you can see once I have my 11A amounts, I just continue that with Rand. So I never convert that again, I keep my debt separate. But when the debt is now written off, I have to convert the write-off of the debt at the date that it is written off. So they say that it was written off when the debt, when the exchange rate was, at year end was 1510. Okay. So now my write-off amount is 1510 times 500,000. Now my question is, which rule do you apply in this scenario? Which section is now applicable for the write-off? Can you remember? If I'm the borrower and I bought trading stock on credit, section 19 sub 3. Okay? Because I still have my trading stock on hand. So in terms of 19.3, I must reduce my trading stock on hand with the amount that is written off. Yes? So I can reduce my trading stock on hand to null, because my amount written off, the reduction amount, is 7550. Let me just get that amount written in here. It's 7550. Okay. But can you see that that's now a little bit too much? So I've got debt written off because I converted it on the day that I have that amount written off, 7550. But my trading stock, opening stock amount is only 6050. So if I reduce that with 6050, I still have a little bit of an excess amount, and my balance that I haven't written off now is 1.5 million. So that one I've done to the extent of that 6050, and now I have an excess amount of 1.5 million. Now my question is, what do I do with the 1.5 million? 84A. 84A? Okay. What else happened here before I do the write-off? Don't I have a 24I for that year as well? Yes. I have the debt being realized. Come to a realization date. So I have to do the debt, which is then from 1510 to 1560, to the date when it was sold. Oh, sorry, no, do I have the right date there? Here's my exchange difference. It's there, 1560 to the 1510. Times my 500,000, and in that year of assessment, I will have a gain of 250. Okay. So what I want you to do first when you do these calculations is I want you to always look first for your 24I. Okay. So for logic, do your 24I first. Okay. And then you do your write-off. So now I've got that excess of 1.5, and you're right, we have a recoupment. How much is my recoupment? Is it the full 1.5 or is it limited? It's the full one. Why is it the full one? Because I had a deduction of 1750, a foreign exchange loss. So to the extent that I had that foreign exchange loss, I can have a recoupment of the 1.5 million. So this is a 24I for recoupment. Just show you that one. No, not 24I4. This is the borrower. This is a normal section 8.4A recoupment, because we said 24I is part of my section 8.4A rules. Okay. 24I4 we only do for the lender. The rule for the recoupment rule, 8.4A, can go for either one, but in this case we have the borrower, he deducted 24I with a loss, we can recover the loss in terms of 8.4A. The gain that is there at the bottom, the foreign exchange gain, will always remain taxable. You can only do a loss that you can reverse with your 8.4A recoupment. Does it make sense? Principles okay? Okay. So I've loaded, I will just double check, but I think I've already loaded it, otherwise I will do it after the class. Your homework questions from that question book. It's not going to take you so long, it will be half an hour to an hour, but make sure you understand the principles before you try those homework questions. And then I really want you to put an effort into that silk example with the 24J. Okay. I'm going to put that test out here, and then I'm going to give Jade a call that she can start as soon as she gets here.
When there was Fetsang and Marco who borrowed money to Green Fingers, so there was a loan outstanding, and then they had a debt reduction at the same time that they had a liquidation distribution. Okay, so the first question was, we said, state with a brief reason why green fingers would not qualify for any deduction under the following sections. Okay, so the main error that you guys made here was you discussed too much. So this was 2 marks in total out of 120. So if you see a question that counts 2 marks, we don't want a whole page for you to explain why they can't qualify for it. We want sort of 1 word or 1 line that says that's why they can't receive the deduction. Okay. The only problem is then you penalizing yourself in terms of time. Okay, so you might have still gotten the marks, but you're just wasting a lot of time for the other questions. Okay, but most of you got all of these, except for the last one for section 13 quin. A lot of you said that the reason why they can't get 13 quin is because it's not a commercial property. And is a commercial property, we said in the question that it is used 100% for business purposes. So it is a commercial property. The reason why they couldn't get 13 quin was because they were not the owner, which is a requirement for 13 quin. Okay, you guys all fine? Do you have any questions there? Okay, so the second part, question 1b, we asked you to discuss supporting with reference to legislation. Make sure that when you see the question, you check, are we asking you for the reference to legislation or not? Okay, in this question we did want reference to legislation. So we said discuss the tax consequences for Fetsang, Marco and Green Fingers. So Fetsang and Marco are the lenders, and then Green Fingers is the borrower. So you have to discuss it from both perspectives. Okay. So just in terms of exam technique, it's always better when you're dealing with debt reduction to start with the borrower's consequences. Just because when you deal with the lender's consequences and you discuss the capital loss that they have, it can depend on what the borrower included into their gross income. Okay, so specifically with this scenario, because Fetsang was a connected person to Green Fingers, paragraph 56 applied. Okay, so I'll show you now how paragraph 56 applied. So firstly we discussed that for the borrower, Green Fingers, you had to keep the 2 debts separate. So there was a debt from Fetsang which was 33,000 Rand, and that related to an allowance asset, which was the equipment, okay? And then there was the 50,000 Rand from Marco, which was a capital non-allowance asset. So you have to keep them separate when you're dealing with the tax consequences. You can't discuss them together because they have different sections that apply in respect of them, okay? So for the 33,000 from Fetsang, remember, in general, just a future technique, always look out for if there's connected persons. Because if there is a connected person relationship, there's usually specific rules that apply to that section in the Act. Okay, so like with debt reduction, if they are connected persons, you have to look out for section 12A6E, paragraph 12A6E, sorry, as well as paragraph 56. Okay, so because Fetsang was a connected person to Green Fingers, you had to mention that he was a connected person, therefore paragraph 12A6E applies. If paragraph 12A6E applies, it says you do not reduce the base cost in terms of paragraph 12A3. Okay? So some of you said you won't reduce the base cost in terms of paragraph 12A3 because the base cost is already 0, which is also correct. But even if the base cost was not 0, you still would have not applied paragraph 12A3 because paragraph 12A6E says because they're connected persons, you do not reduce the base cost. Do you guys understand that? Okay. So therefore, because we could not reduce the base cost, it was an allowance asset. So then you go into section 19.6 and you recoup the full 33,000 Rand debt write-off amount. Okay. Does that make sense to you guys? Okay, so that was 4 marks for discussing Green Fingers tax consequences in respect of the debt owed to Fetsang. Okay. Then you had to discuss the debt owed to Marco, which was 50,000 Rand, which was in respect of a capital non-allowance asset. So when you're dealing with a capital non-allowance asset, the main thing you want to look out for is this asset still on hand? Because if it is still on hand, you want to reduce the base cost. If it's not on hand, you go to 12A4 and you reduce the assessed capital loss. A lot of you went to 12A4 and you said reduce the assessed capital loss, but in the information, if you go and draw yourself a timeline and read on what dates the specific thing happened, you would see that the shed was still on hand at the time of debt write-off. There was about 1 day apart from the disposal as well as the debt write-off. So because it was still on hand, you reduce the base cost, paragraph 12A3, by the full debt reduction amount. Okay, and we also allocated a bonus mark there for saying that Marco is not a connected person, therefore you can reduce the base cost in terms of paragraph 12A3. Okay, are you guys fine with that? Okay, then remember we also wanted the lender's perspective. So you had to discuss what happens to Fetsang and what happens to Marco in respect of this debt reduction. None of them were money lenders. They're not going to get 11I or 11A deductions for this debt write-off amount. It was a capital loan that they gave to Green Fingers. Therefore, if it's a capital loan, there will be a capital loss. The proceeds is null because they are giving up the right to receive an amount from Green Fingers. Does that make sense? So if you are disposing of a right to receive an amount of money, there will be CGT. So your proceeds are zero because you're not receiving anything in respect of that debt, and then the base cost is the debt reduction amount. So therefore, Fetsang had a capital loss of 33, Marco had a capital loss of 50,000. But then again, when you're dealing from the lender's perspective, you have to discuss whether there's a connected person relationship, because if there is, then paragraph 56 applies. Okay. So the main thing in this question that you guys forgot to look out for was the connected person relationship. If you missed out on that, you missed quite a few marks for discussing the relevant tax consequences in respect of that. So whatever information we put in the test, we put it there for a reason. There's a reason why we said to you what the percentage shareholding is. So in the future, when you read your test or your exam, make sure you ask yourself, why are they giving me this information? Why are they telling me what the percentage shareholding is? Does it have a relevant consequence on the tax consequences? Okay. And then some of you did identify that paragraph 56 applies, but you didn't apply it correctly. So paragraph 56 says that for the lender, they have a capital loss now. Paragraph 56.1 says you disregard that capital loss. But then you have to go to paragraph 56.2, which says, unless to the extent that the borrower included an amount into their gross income or reduced their base cost in respect of the debt reduction. So that's why, in terms of exam technique, you do the borrower's tax consequences first, so that you can see if that has an impact on the capital loss that the lender realizes or not. Okay, so because Green Fingers did have an amount of 33,000 inclusion into their gross income, paragraph 56.2 applied, said basically we only penalize one party in terms of this debt reduction. So we've already penalized Green Fingers. They had a recoupment into their gross income. They've been penalized. So we won't penalize Fetsang as well and say you may not recognize your capital loss. We say because Green Fingers has been penalized, now Fetsang may realize the full capital loss. Okay, does that make sense to you guys? Do you have any questions? Yes? The connected person's definition, yes?
Yeah, I think where I got it confused, I read individually and jointly with any connected person at least 20%, at least 20%. So I thought because Fetsang had 90 and Marco had 10, then jointly, I think that's how I interpreted it.
So then did you say that Marco is also a connected person?
Yes.
But they must be connected to each other. Otherwise, I mean, you have two separate people. So if you have a brother and the two brothers having, and then they connected, then you can maybe have a different
So
thing.
Marco and Fetsang should be connected
In order for you to try and determine that they're all together connected.
to the company.
Yeah. So they're separate individuals. So in order for them to be connected to the company, you only look at the shareholding.
Okay, does that make sense? Okay. Okay, so the next part of this question, still relating to the debt write-off, question 1C, was calculate the normal tax liability of Green Fingers for the 2018 year of assessment. Okay, so remember, this was now the year that they went into liquidation. So there's specific rules that apply to your final taxable income in your year of liquidation. Okay, so first of all, there's a deemed disposal of all your assets. Even in this information, we gave you all the information relating to the disposal of those assets. So what happens when you have a disposal of an asset? CGT. A lot of you forgot to do the CGT consequences in this question, okay? And that's where you missed most of your marks. Okay, so the first thing that you had to mention was the Section 19(6) recoupment, because obviously that's an inclusion into taxable income. And you just discussed it in the previous question, so it was just half a mark for carrying forward the right amount from your Part B. Okay, and then you got, so a lot of you then went and calculated on the actual disposal of the equipment, you went and calculated another recoupment and included that into your gross income again. But you've already included a recoupment of 33,000 Rand into your taxable income in respect of that equipment. Even though it was as a result of debt reduction, it wasn't as a result of disposal, you can't now go and recoup an extra amount because you've already recouped 33,000 Rand. Does that make sense to you guys? So if you had gone and done that recoupment calculation, then you would just have to consider the fact that we've already recouped 33,000 Rand in terms of that equipment, so we can't have another recoupment on actual disposal. Okay. And then liquidation costs, most of you forgot that liquidation costs are not in the production of income, so you cannot get an 11A deduction for that. So that was 1 full mark for indicating the fact that you can't deduct it from your taxable income. Okay. And then the assessed loss of 16,500 Rand was not allowed because Green Fingers did not trade in the 2018 year of assessment. We did not give you any information about them selling their trading stock or buying more trading stock and actually trading. This year was, all they did in this year was they were liquidated, they had deemed disposal of all their assets, and that was it. Okay, so therefore your assessed loss is ring-fenced. In order for you to get the Section 20 assessed loss deduction, you have to be trading. Okay, so therefore it was ring-fenced. So that was another full mark for saying that. And then, like I said here, most of you guys didn't do the CGT calculation for the disposal of these assets. So there was a capital loss on the write-off of the loan to the employee, that was 1.5 marks. And for mentioning the fact that you don't get a Section 11(1)I bad debt deduction, that was 0.5 mark. Okay, because the loan amount, the amount from the employee was not previously included into your gross income. One of the requirements for Section 11(I) is that that amount of debt must have previously been received into your taxable income. Okay. Then there was capital loss on the disposal of the trade debtors, CGT on the disposal of garden service assets. So then here, your base cost was 0 because we told you that the tax value was 0. They had already reduced the base cost in terms of all the Section 11(1)E capital allowances that they received. Okay? And then CGT on the termination of lease. So then again here, do you see with the base cost, that is relating to Marco's debt reduction amount. So in your previous question, you had discussed Marco. In terms of Marco's debt, the debt write-off, we reduced the base cost in terms of paragraph 12A3 to 0. So now the base cost that you use here on actual disposal, you have to use 0. Okay. So on the date of debt write-off, there's no actual CGT consequences for a capital asset other than you simply reduce the base cost. You're simply calculating a new base cost for the future when you actually do dispose of that asset. So now in this year they are disposing of the assets, so you have to carry forward that base cost amount that you had calculated on debt write-off. Does that make sense to you guys? Do you have any questions? Okay. Then you got 0.5 mark for summing up the total capital gains and losses and then multiplying it by 80% because Green Fingers is a company, so their CGT rate is 80%. That was 1 mark just for using the correct percentage. So don't forget to just, before your test, just revise those little percentages if you are not sure of them, some of you use 66.6%, but we are using the new rates, which is 80% and 40% for natural persons. Okay, that's a very easy 1 full mark that you could have missed out on. Okay, so make sure you use the correct rates. And then a company is taxed at 28%, so you got half a mark for multiplying your total by 28%. Okay. Then the last question in question 1 was part D, where you had to calculate, let me just zoom in a bit more here. You had to calculate the final amount distributed to Marco. Okay, so do you guys remember that in my tutorial on the 3rd of June, I showed you how to calculate the final distribution on liquidation? Okay, so this was using the cash method. You had to calculate how much cash was left after the distribution, after the liquidation, sorry. So you take all the cash that you have on hand as a result of the disposals or an amount received from the debtors, that's how much cash you have, and then you minus all your liabilities that the company has. Okay, and remember, this part B that we just calculated, that final normal tax liability, that's a liability owed to SARS. Okay, so when you're being liquidated, you need to make sure that you pay that liability to SARS. So you have to deduct that from the cash that's available to distribute to the shareholders. Okay, so for carrying forward that mark, for carrying forward the final tax liability, you got a separate mark there. So that was 2 marks for calculating how much cash you had on hand. And then you had to, for making a split between the CTC and the dividend portion, you got 1 full mark. Why is that important? Because the amount that Marco receives as CTC will be treated in terms of CGT consequences. And the dividend portion will be treated in terms of dividends tax, and they'll have a gross income inclusion and a 10(1)K exemption. So it's very important that you made that split. Some of you just took the full amount and you said, this will be the dividends tax on that full amount. Okay, you have to take out the CTC. Because remember, upon liquidation, you can assume that the full amount of CTC not yet paid out to that shareholder will now be paid out to that shareholder. Okay, so we gave you the information. We said the share capital was, I think it was 10,000 Rand. And then because Marco owned 10%, he received 1,000 Rand, which was his CTC. Okay, yeah? Sorry? It was included. So we corrected this, the memo that we have uploaded for you, we have corrected it. So this was actually an error here. The original amount that we had was 4,000, but it's the 3,855. So he just asked, upon the termination of the lease, the amount that we received from the lessor, the 3,855, he asked why was it not included in the cash available, and it is included. If you go see the solution that we've uploaded, it does have the correct amount. So this was just the one that I printed originally and it had the wrong amounts in. Okay. So then you got 1 mark for splitting the CTC and the dividend portion, and then for treating them both separately. So the dividend portion, you include into gross income and you have a 10(1)K exemption. That was 1 full mark. And then for the CGT consequences on the disposal of his shares, remember that CTC portion that he now receives from the company, that will be seen as proceeds. Okay? And then the base cost was also 1,000. Is it 100? Sorry, it's 100. So then he has 0 CGT consequences, no capital gain. Most of you did really well in this question, and I hope that's because you watched my tutorial video. Okay. Do you guys have any questions for question 1? Are you all fine with that? Okay, so question 2A was Peter, who carried on his business, his antique business. So this question 2A says, state the purpose of the notional input tax deduction available to Peter when he acquires second-hand pieces of furniture from non-vendors. Okay. So remember, Peter is not the final consumer of these antiques. He's going to add an amount of value onto it, and then he's going to levy output VAT on that total amount that he's added. Okay? So effectively, SARS just wants to give him the opportunity to have an input tax claim so that eventually he only actually pays VAT on the portion of the value that he added to that asset. Okay, so the answer was that if he had not had this input tax deduction, he will carry the full VAT burden on the full selling price instead of only on the value that he added. Okay, another thing that you could mention there was just to level the playing field in the second-hand market. So in other words, whether a vendor purchases from a non-vendor or a vendor, the result should be the same. Okay. So part B said calculate the VAT consequences for Peter of donating the furniture to the PBO. A few of you went into section 1023 and you said that this was a supply at no consideration, but this is not a supply at all. It's a donation. It's completely separate from him making a supply in the course of the furtherance of his enterprise. Okay, so he just purely made a donation to this PBO. So what is a donation? Is there VAT? Does he have to levy VAT on that? No, it's exempt. So originally, he was planning on levying 14% on this asset, but then he changed his use. So originally, he purchased it for taxable supplies, but then he changed his use to exempt supplies. So there's a change in use adjustment. So the essence of this adjustment was that when he purchased it, remember for section 17.1, to get the input deduction, you have to use that asset in the course of furtherance of creating taxable supplies. But now he ends up using it for exempt supplies. So he was allowed the input tax, but now he's not going to be using it for taxable supplies. So SARS actually says, I want you to reverse that 17.1 input that you had originally claimed, because you're not using it for the purpose that you said you were going to use it for. You're now donating it. Okay, so therefore there's an 18.1 adjustment. So you got 1 mark for mentioning the correct section, and then that is an amount of output tax payable. You had to clearly indicate that this was output tax. You can't just do the calculation and not say what he does with that amount. So he does the calculation, and that's the amount of output tax that he pays. So effectively, this output tax is cancelling the input tax claim that he originally claimed. Do you guys understand that? Okay. Okay, so question 2C was calculate the taxable income of the late Peter for the period 1 March 2016 to 31 December 2016. So whenever you're dealing with the final taxable income of a deceased individual, draw yourself a timeline or just quickly do a little calculation in your head and calculate how many months of this year was he actually alive. Because we have to apportion all the amounts that he receives in terms of those number of months up until his date of death. Okay, so if you just put a little reminder for yourself in the beginning of the question, you say he was only alive for 10 months, then you make sure that all the salary that he receives, you only include a portion of 10 months. Do you guys understand what I'm saying? Okay. So the main thing that a lot of you missed out on here was that there was deemed disposal of everything that he held. So because he's carrying on a trade, you did not have to have a remuneration column. You wouldn't have lost marks if you had a remuneration column, but you're just wasting your time drawing that column every single time. So make sure you read the information carefully before you start writing out your framework, because he didn't actually receive a salary or anything in terms of calculating remuneration. Okay. So he only had a column 1 and a column 3 because he received certain lump sums. So section 9HA says that there's a deemed disposal of all the assets that he held, and also all the trading stock that he held, there's a deemed disposal of that as well. So there won't be CGT on that, but there will be a specific inclusion into gross income at the market value. Okay, so the opening stock amount was given. You had to deduct that 375,000, And then the furniture that he donated, remember, that's again a change in use of your trading stock. So there's a section 22(8) recoupment, and you include that at the cost price into your taxable income. Okay? And then he received a life insurance policy, so you included that amount into column 1 because it was favorable, because he received it on in respect of his death. So whenever you're deciding into what column it goes into, you ask yourself, did the taxpayer voluntarily receive this amount? He didn't voluntarily die, so it's favorable. Whereas if you voluntarily withdraw an amount from a fund, you chose to do that. So that will be in the unfavorable column in column 2. Do you guys understand that? Okay. And then, so here's the section 9HA, deemed disposal of the trading stock at market value. And then there was recoupment of the wear and tear on the delivery truck, because again, it's a deemed disposal of that delivery truck. And before you have disposal, before you do the CGT calculation, you always need to consider, will there be a recoupment or an 11O on this disposal as well? So 9HA does not just apply to CGT, it also applies to a possible recoupment. Okay, so because he did receive 11E deductions on that delivery truck, he now had to calculate a recoupment in terms of 9HA. So then you had to calculate your subtotal, and you had to calculate section 11K. So when you show your subtotal, make sure that you clearly indicate to the marker where you use that subtotal in your 11K calculation. Because section 11K says that you first calculate how much was actually contributed to the funds. So when you did that calculation, it was 6,500 times 10 months. And then you limit it to the lesser of subtotal A, which is your taxable income. So make sure that you show the marker, I got this amount, my taxable income plus my taxable capital gain. It's firstly this subtotal, and then I went and added my taxable capital gain, which was my total taxable capital gain. Sorry, let me just find that. It was this 916474. So if you had done your taxable capital gain calculation first, that's fine. It's sometimes easier to do that because then you can just carry it forward quite easily. So as long as you showed the marker very clearly that I got my taxable income amount from here, and I got my taxable capital gain amount from here, and that's how I calculated my 11K limit, then you would have gotten the full mark. So even if your CGT calc was incorrect, if you didn't get the right amount that we had in the memo, as long as you carried it forward to your 11K correctly, you would have gotten that mark. Okay, so if you use a highlighter or you put a little star next to your subtotal, as long as you show the marker, this is where I got my subtotal from, then they will give you the mark. Okay, so spend some time almost making it easier for the marker to find where you got your amounts from. Because if the marker has to go and look at your whole framework and see where did they get this amount that they added here, they're not going to give you the mark. They're not going to spend 10 minutes trying to figure out where you got your amounts from. Okay, does that make sense to you guys? Okay, so then remember section 11K is always limited to the actual amount contributed, so then you got one full mark for limiting it and deducting the amount actually contributed. Okay, so then section 9HA applied, and there was a deemed disposal of all the assets held. So the deemed disposal is at market value on date of death. So yes.
Depreciation is going back. Wouldn't deduct the portion for depreciation for a period after death?
The wear and tear.
The disposal of that vehicle. Recoupment.
There's a recoupment of the wear and tear on the delivery truck.
Stayed at its market value and tax habits. You didn't deduct the portion for depreciation for a period, which I did.
Oh, so you're saying that there is no wear and tear in this calculation? There is wear and tear over there. Delivery truck wear and tear, section 11E. Yeah, so you do calculate the wear and tear for the year up until the date of deemed disposal. Then you calculate recoupment and then CGT. Okay. So then you did the taxable capital gain calculation. So the proceeds that you used for each asset that was disposed of, you used the market value on date of death. And then a few of you here, with the transfer duty amount paid on acquiring the fixed property, that's 73,000 Rand, you either forgot to include that into your base cost or you deducted it from your base cost. But this was an amount that you incurred in acquiring that asset. So it increases the cost that you paid for that asset, so it increases your cost price, your base cost. Okay, so that was 1 full mark for increasing your base cost by the transfer duty paid. Okay, and then you got 1 full mark for using the correct annual exclusion from your CGT, which is 300,000 Rand in the year of death. So do you see how these small things can add up to quite a lot of marks? Like, for example, using the correct CGT annual exclusion, using the correct CGT rate of inclusion, so either 80% or 40%. And so just make sure that when you're dealing with your question, you think carefully of what amount am I including it into my taxable income. Okay, because those marks can really very easily add up and it's easy to miss them. Okay. And then you had an 18A qualifying donation because we said it was donated to a PBO. So again here with the 18A donation, you are limiting your deduction amount to the previous subtotal in the taxable income. So this is the subtotal that you are going to use to check the limit of your 18A qualifying donation. So again, you have to show the marker very clearly, this is the subtotal that I used to calculate this 10% as the limit of my 18A deduction. Do you guys understand? So if your subtotal here was incorrect, but okay. So if your subtotal here was incorrect, but you carried it forward to your 18A calculation correctly, and you said 10% multiplied by that is my limit, you got 1 full mark for doing that. Okay. So again, make it clear to the marker, this is where I got my amounts from. Okay, that was it for question C. Do you guys have any questions on question C, 2C? Okay. And then question 2D was calculate the normal tax payable in respect of the lump sum payout from the retirement annuity fund. Okay, most of you did quite well in this question. The main thing that you need to check out for is, did this individual receive a lump sum previously, before these lump sums that he's receiving now? Because if he did receive a lump sum previously, it might have been taxed in terms of a different tax table. That's when you have to go and calculate the hypothetical tax. So hypothetical tax is that previous lump sum that Peter received, that would have been taxed in terms of column 2, because it was a retirement lump sum withdrawal benefit. Right? So that's unfavorable. There's completely separate tax tables for that. But now, this lump sum that he receives upon death, that is favorable. So it's taxed in terms of column 1. So the first thing that you have to do is you add those 2 lump sums together for 1 mark, and then you tax them in total in the favorable column. So you tax it in the column that applies now on this payout on date of death. Okay, so this lump sum received on date of death is favorable. So you put this total amount into your favorable column and you calculate the tax on that total amount. Then you minus the hypothetical tax. And the hypothetical tax is that previous lump sum that Peter received, what would he have paid? What is the tax that he would have paid if it was taxed in terms of column 1? It wasn't taxed in terms of column 1, it was taxed in terms of column 2, but how much would he have paid if it was taxed in terms of column 1? So then you put that amount into the favorable tax table again, and you deduct that from the total, and then you get the 450,000 Rand, which is the normal tax payable in respect of the 1.25 lump sum received. Do you guys understand that principle of calculating hypothetical tax and why you calculate it? Okay. Okay, so question 2E said, briefly discuss why the estate had to levy output tax on the sale of Peter's antiques. You do not have to discuss the requirements of section 11.1e. So a lot of you went into section 11.1e and you discussed that. But that's why you have to read your required very carefully and make sure what we are asking of you. We said, please do not discuss section 11.1e. So if you did, you're just wasting your time, okay, because there's no marks allocated to that. So essentially what this question was asking is, why did the estate have to levy the VAT? That was the focus of the question. Is normally Peter would obviously levy the VAT because he was the registered VAT vendor. But now Peter died. So now the estate is carrying on the enterprise in terms of the termination of the enterprise. So why must the estate now go levy VAT? Okay, so the relevant section that applies here is section 53, which deems Peter and estate to be the same person, one and the same person in terms of the VAT Act. So technically it deems that Peter's estate to be the VAT vendor for that trade. Okay, that was for 2 marks for mentioning that. And then another mark was for discussing the definition of an enterprise includes any activity incurred in the termination of an enterprise. So if you are selling items because you are planning on terminating your enterprise, that's still seen as carrying on an enterprise. Okay, so that's why it qualified for section 7(1)(a), and therefore the estate would levy 14%. Okay, that was a bit of a tough question, but at least now you guys know what to do next time. Okay. So question 2F said briefly discuss the VAT consequences for Mr. Rich on 15 January. So the main thing you had to see here was in the information we said to you section 11(1)(e) does apply. So section 11(1)(e) is what you discuss when you are considering what the seller would levy the selling price at. Would they levy it at 0% or 14%? But we already told you section 11(1)(e) does apply, which means that the sale of this fixed property was levied at 0%. So now Mr. Rich acquired that fixed property at 0%. He did not pay VAT. So that's a benefit that he's receiving from SARS. So SARS says if you did not pay any VAT upon acquiring the fixed property, the only reason why I'm giving you that benefit is because you are going to be using that as a going concern, right? That's what section 11(1)(e) applies to in terms of a going concern. So SARS says because you are going to be using it to get taxable supplies, you're going to be generating VAT for me, so that's why I zero rated the sale for you. But now the buyer says, no, I'm not going to use it 100% for taxable supplies. I'm going to use 15% for exempt supplies, and the rest I'm going to be using for taxable supplies. So SARS says, okay, but now you receive that benefit in terms of section 11(1)(e). You paid 0% on the acquisition of the fixed property, so you will have an 18A buyer's penalty. Okay, the 18A buyer's penalty is a calculation of output tax, and you're calculating it on the portion that the buyer will be using that property or asset for exempt supplies. So SARS is just penalizing this buyer and saying, you are not using it completely for taxable supplies, so the portion that you're going to be using for exempt supplies, you now have to calculate output tax, which is a buyer's penalty. Does that make sense to you guys why 18A applies? Okay, so for mentioning section 18A, you got 1 full mark. And then for doing the calculation and saying that that is an amount of output tax payable, you also got another mark. Okay, yes? The percentage of VAT is 14%. So you use the selling price of the fixed property, and then you multiply it by the percentage that's used for exempt supplies, which was 15%, and then you multiply it by 14%, because remember, we said in terms of section 11(1)(e), that selling price was levied at 0%. So it does not include an amount of VAT. That's why you multiply it by 14 over 100, because it's the selling price excluding VAT. Do you understand? Sorry?
Is it the same for question, the second one, D?
B?
Yeah.
There is no B here.
No, when you go up.
E.
The second question 2B.
Okay, question 2B. Yes, question 2B was output tax.
So also 14%.
Yes, that was also 14%, excluding VAT. Because when you are levying an amount of output tax, you're calculating it on the selling price, which doesn't include VAT yet. Do you know what I mean? Does that make sense?
The question said including VAT. We specifically said it excluded VAT, so that's why it was 14%.
Okay.
in that B part. So
Oh yes, so we gave you the market value, and just before the transaction information, we said note that all the amounts exclude VAT. That's why you multiplied it by 14%.
and then if we use the term open market value, then we would have included the VAT.
Yes. So we, in the information, I think we said retail market value. But if we said open market value, then that does include VAT. Okay. Okay, are you guys all fine with question 2F? Okay, question 2G was calculate the taxable income of the deceased estates of the late Peter. Okay. So what you need to remember here is when the deceased person, when he dies, he basically transfers all of his assets, all of his trading stock to the estate. And then the estate deals with it in terms of the will and in terms of whatever provisions apply. Okay? So you have to calculate the estate's taxable income up until the end of the year. A lot of you calculated estate duty here, but estate duty is a completely separate tax. So if you calculated estate duty, you got 0. Okay, so make sure you read your information carefully and the required carefully, and you read that we said calculate the taxable income of the deceased estate. Okay, so when you're calculating the final taxable income of the estate, you look at section 25, which is the Income Tax Act section that says you deem the deceased individual as well as the deceased estate to be the same person. So therefore, upon the sale of the trading stock, what would Peter have done if he sold trading stock? You have a specific inclusion into gross income. So now, section 25 says whatever would have happened to Peter, we just do that for the estate, for their taxable income. Okay? And then because the estate is now the new owner of the delivery truck, they will have wear and tear on that delivery truck. And then they sell the delivery truck, so you have an amount of 11.0 or recoupment. And then there's CGT because there's disposals of those assets. So also just remember here that the estate acquired the assets at market value from the deceased person. So therefore the base cost in these CGT calculations is the market value at the date of death. Okay. And then again here, make sure that you use the correct annual exclusion. Only the deceased individual receives 300,000 Rand as the annual exclusion, okay? The estate itself receives 40,000 Rand annual exclusion, same as a normal natural person, and then an inclusion rate at 40%. Okay, are you guys fine with that question? Okay, the last one, 2H, said state the amount of section 4A abatement available to Hetty's estate on her death. Okay, so what you need to realize here is that Peter was previously married to Dalian, and any amount that Peter did not use from Dalian's abatements will not now carry forward to Hetty's 4A abatements. Okay, so Peter's net value of his estate was 3 million. Then he would have had a 4A abatement of 3.5 million, but he only used 3 million. Therefore, there's an excess of 500,000, plus Hetty will receive her own 4A abatement of 3.5 million, so she has a total of 4 million. That was one mark. Okay. So question 3A said, in respect of note 1, discuss the VAT implications arising for RJ from the extension of its offices to include the top floor. So what you had to identify here was originally they were using this capital asset as partly for taxable supplies and partly for exempt supplies. So because residential accommodation in terms of section 12C is exempt. So you got one mark for identifying that section 12C applied to that top floor, therefore it was exempt. And now you are changing the use from partly exempt and partly taxable to fully taxable. So there's a section 18.5 adjustment. So the main thing you just need to think about here is originally when they received that fixed property, because it will be used partly for exempt supplies, they were denied the input on that top floor, right? They wouldn't have been allowed to claim input. But now they're changing their use and they're saying, I actually want to use this fixed property 100% for taxable supplies. So what do they want? They want an input tax. They want to claim input tax on that top portion. So this is where section 18.5 applies. It applies to capital goods costing more than 40,000 Rand. So because the fixed property was 10 million Rand including VAT, it did consist of a capital good which cost exceeded 40,000 Rand. So therefore 18.5 can apply. And then important here was to mention that the time of the change in use is at year end, not on the date of change in use. That's the rule that you get in section 18.6. Okay, so then for doing this calculation, if you go to 18.5, it exactly sets out the calculation for you. It says you take A multiplied by B multiplied by C minus D. Okay, and then you just fill it into the formula. And important here, you had to indicate that this is an input tax adjustment. This is an amount that they can claim as input tax. Okay? And then a lot of you did not discuss enough things for 10 marks. You need to make sure that you look at the allocation of the marks in the question. If it's 10 marks out of 120, you can't just discuss the calculation amount. You need to discuss the fact that it is a capital good exceeding 40,000 Rand, what date the time of supply was, and so make sure that when you're going through your past papers, you see how much we expect you to discuss for the relevant allocation of marks. Okay. Question 3b said, with reference to note 2, calculate the effect of the given information on RJ's taxable income. So remember, RJ was the employer. So now we're asking you, from the employer's perspective, what happens when they give a fringe benefit to an employee? Okay, so some of you missed this very easy mark for just saying that the salary amount that they paid to Dennis was an 11A deduction. Very simple. Sometimes you guys get too confused with the technical section that's going to apply and you forget about the simple basic ones. Okay, so section 11A, there's a deduction of the salary amount. Then the fringe benefit, remember, for VAT purposes, there's a deemed supply for VAT purposes. So they have to go and calculate output tax and pay that output tax. But because this fringe benefit is almost seen as like a salary paid to Dennis, the company may claim that deemed supply of the fringe benefit. They may claim that output VAT as section 11A. So then you actually refer to section 18.3 of the VAT Act, which is how you calculate the output tax payable by RJ. So this is the calculation over here. And then you get that as an 11A deduction. Okay, that was 2 full marks. And then remember, RJ is the owner of the vehicle. So they will receive wear and tear, and we told you that they are a small business corporation. So they receive section 12E, not section 11E. Okay, but if you did mention section 11E, we still gave you the marks there for identifying the fact that they receive wear and tear because they're the owner of the assets. Okay, and then the maintenance contract as well as the fuel paid for the employee is also received. They also receive an 11A deduction. So then part C says, with reference to note 2, calculate the effect of the given information on Dennis's taxable income. So this is the same fringe benefit that's relating, but we're asking you to discuss it from the employee's perspective. So the employee is receiving a salary, that's a specific inclusion into gross income. They're also receiving a fringe benefit. So that's how you go and calculate it in terms of paragraph 7 of the 7th schedule. And this is the amount received as the fringe benefit. That was 2 marks for calculating it correctly. And then you minus the business portion, and then you minus the private fuel that relates to private kilometers, and then that's how you get the total fringe benefit inclusion into gross income. Okay, so a lot of you didn't get this. This is the section 7.7 adjustment, and this is the section 7.8 adjustment. A lot of you didn't get those adjustments correctly. Just go and revise that and make sure that you get it correct next time. Okay, so for section 7.7, you are taking out the business portion of the fringe benefits. because you are not going to be taxed on a fringe benefit that you're using for business purposes, because then it's not actually a fringe benefit. It's a cost for business purposes. So you shouldn't be taxed on that amount. Okay. And then some of you said that maintenance and petrol received from the employer is a separate benefit, separate fringe benefit, like an asset received at a lower than the cost price, but that's already included into this fringe benefit calculation here. That's why you taxed at 3.5% on the benefit, on the total determined value, because it includes a maintenance contract. The employer is also paying for a maintenance contract. Okay. Do you guys have any questions? Okay, so question 2D says, discuss the capital allowances that the company will claim during its 2017 year of assessment. So again, the reason why we give you specific information is because it actually has an effect on the tax consequences. So we told you that this is a small business corporation. We didn't ask you to discuss that. We just asked what are the allowances that they will receive. So firstly, for the computer program, they will be entitled to either 12E. So then you calculate the 12E, you get 1 full mark, or they can get an 11E write-off of 6,000 Rand. So then you compare the two and you choose which one is more beneficial. Okay? Then the same applies to the 3 standalone PCs. So remember, in terms of 11E, for a small asset that costs less than 7,000 Rand, you can get the full cost price as an allowance in the year that you acquire it. So obviously you'll choose that because that's way more beneficial. And then in terms of the manufacturing equipment, Section 12E allows them the full 100% cost price as an allowance. And then they'll be entitled to 11E on the market value in respect of the component donated by Candace. Okay, 12E will not apply as there was no cost. So then that's 2 marks for discussing that. Okay. Okay, question 4 was the true or false. The main thing that I just want to show you guys here is the fact that if you got this part A incorrect, so if you said true or false, if you said true but the answer is actually false, then I didn't even go and look at your section quoting, because it means that whatever you did quote, you interpreted incorrectly. Okay, so if you got this one incorrect, you wouldn't have gotten the mark here. Okay. I'm not really going to go through this one. You can go through the memo and see which sections relate and what quote you could have used from the legislation. Okay. And then the last one was question 5, which was again debt write-off. So relating to scenario 1, we said briefly discuss the normal tax consequences for rebuck. Okay, so rebuck in the scenario is the borrower. So what happened was we had a part debt write-off initially, then we had disposal of the assets, then we had a further debt write-off. So on the first debt write-off of 700,000 Rand, the asset was still held. So because it's a capital asset still held, you want to apply paragraph 12A3, you reduce the base cost in terms of paragraph 12A3. And then you actually dispose of the asset. Some of you just forgot to, we wanted for both years, for the 2017 year of assessment, you had to first discuss the new base cost and then the capital gain, and then you had to calculate in terms of 2017 what would happen then on the further debt write-off. Okay, in 2017, the asset was no longer held. So what do you do for a capital asset that's a non-allowance asset no longer held? You simply reduce the assessed capital loss. Okay, that was the further 2.5 marks. Okay, and then relating to scenario 2, we said briefly discuss the normal tax consequences for company Z, which in this scenario is the borrower. In 2017 year of assessment, you first reduce the base cost because the asset was still held. So it was a capital asset still held, so you reduce the base cost in terms of paragraph 12A3. So then you have a new base cost of 160,000 Rand. And then on the date of disposal, remember before you calculate CGT, you always have to go calculate either recoupment or section 11O. So on this disposal, you actually got an 11O of 130,000. But because there was a debt write-off on this asset, there's a specific rule that applies to the section 11O scrapping allowance. And that's section 19.7. There was 2 full marks for discussing section 19.7 and showing what the limit is of the 11O scrapping allowance. Okay, so in 19.7 it says that the allowance must be limited to the 350,000, which was the cost price to acquire the assets, minus the 140,000, the aggregate amount of allowances granted, and then minus the 50,000, which was the sum of the debt reduction. Therefore, you get a total of 160,000 limits. So that's what you limit the 11.0 to. You limit the 11.0 amount to 160,000. Therefore, you may recognize the full section 11.0 of 130,000. Okay, so just for calculating the 19.7 limit, you got 1.5 full marks. Okay. And then you actually dispose of the asset, and the proceeds were 80,000 Rand minus the base cost, which was the cost price, minus the total 12C, minus the scrapping allowance, minus the debt write-off. Therefore, you have a capital gain of 50,000 Rand. That's 2 marks for getting the correct capital gain calculation. Okay, are you guys all fine with that? Do you have any questions? Yes. It does say discuss. Yeah. Yeah, we will look at that. Okay. Thank you. Okay. No more questions? Okay. I hope this helps you guys in preparing for your next test and sort of seeing the things that you should look out for and your exam technique and all of that. Good luck.